auch ein anderes Video, was fix da gelaufen ist. Was war das? Eben, was ich.
Es gibt zwei Videos. Einmal eine Movie-Datei und einmal
Ja, lass uns mal checken, ob das fünfte Dings, oder was?
ja, denken können wir das live.
Ja, das heißt 15 Slides. Ich habe vorhin geguckt, aber kein einziges Video. Es ist nur separat, das Video muss eingeschaltet werden. Ist nur da die Frage, wer das Video dann einschaltet, weil da ist ja eins eingeschaltet.
Ja.
Notlaufig runterzuschauen. Ich
Do you have a video that is playing with your presentation at some point?
I don't have a video, no, just slides. Yeah.
So how this will work is there's going to be microphones, obviously. The green microphone will be for the speaker.
Yeah.
That is for you to have it at hand, just talk.
Okay, sure.
Just having it there might be a bit far away.
Got it.
And since we're live streaming also,
Yeah.
camera can just basically the area move around.
Yeah.
Hold the phone of the camera. Your slides are you going back? Sunday. Ich habe gerade nochmal bei Marian abgefragt, nach der 5. Präsentation kommt ein Video und nach der 7. Präsentation.
Welche ist die 5. Präsentation?
Die Slide Präsentation, die musst du da gerne schauen wir gleich machen. Mario schreibt, es ist nach der Mittagspause.
Ja, dann haben wir.
So, this is the clicker then for you?
Yeah.
Guck mal, Kollege.
I mean, you can
Rot.
click or
this on? Yeah, perfect. Welcome everybody in the innovation room. I hope you had a good intro session by the deputy head of the Bundesbank. We're very excited to talk more about the private sector alternatives here in this room, and I'm very glad to have Matthew with me. He will introduce himself, talking more about Ripple. So please give him a very warm welcome.
Thank you very much. Good morning, everybody. It's wonderful to be here. And welcome also to those who are joining us online. So I'm Matthew Osborne, and I'm the Director of Policy for Europe at Ripple. So I cover our policy engagement activity across the Europe region, including the UK and the EU and Switzerland. So I think I have you for about, 19 minutes now. So what I'm hoping is at the end of that 19 minutes, you're going to have a good appreciation of who Ripple are, what we do, and how that's changing at the moment to reflect the evolving nature of this sector. And I'm also going to give you an update on the RLUSD stablecoin, which we issued late last year. So let's get a move on. So Ripple's vision is the Internet of Value, to enable the world to move value just in the same way that information moves today. Our mission has changed over time as the company has evolved. Today, it's to build breakthrough crypto solutions for a world without economic borders. Ripple was founded back in 2012, so we're a relatively old crypto company. We have around 900 employees globally, spread across 15 global offices, with significant hubs in San Francisco, London, and Singapore. We're a compliance-forward organization, and we have over 60 regulatory licenses globally. We've got a New York BIT license, a New York Limited Purpose Trust Company charter. We've got over 55 money transmitter licenses across US states. We have a major payment institution license from the Monetary Authority of Singapore and VASP registration from the Central Bank of Ireland and others as well. We've got a treasury of around $100 billion in assets, which is a key strength for us. So this is a very strong balance sheet, which is equivalent to a Fortune 50 treasury. And we have partnerships in over 90 global payout markets as well, giving us a very wide reach in terms of the global FX market. So I'll come back to talk a bit more about that later. Transformations in the financial services industry today tend to be made at a glacial pace. And that's because even though the current system is ripe for innovation, trust is at the heart of finance, and institutions like to use what they already know. There is a desire amongst financial institutions, however, to catch up to modern times by leveraging new technology like blockchain and digital assets, which reduce friction and make moving value dramatically more efficient. But the potential for those efficiencies is currently locked by the existing system. So financial institutions need simple, trusted, reliable infrastructure to unlock efficiencies using digital assets. But financial institutions aren't necessarily architects by trade, nor do they have the time or resources to build and maintain those solutions in-house. So Ripple provides financial institutions with simple, secure, compliant digital assets infrastructure, which meaningfully improves how those customers tokenize, store, exchange, and move value. And today we provide payments, custody, and stablecoin solutions for banks, crypto natives, and fintechs. Ripple builds on the XRP ledger. That's a permissionless public blockchain, which is enterprise ready, secure, scalable, and proven. Our customer activity is one of the largest enterprise use cases on the XRP ledger today. And the XRP ledger has intrinsic value. It's fast, inexpensive, it's scalable for many use cases in finance today. Ripple provides financial institutions with simple, secure, compliant digital infrastructure, which meaningfully improves how those customers tokenize, store, exchange, and move value. Okay, so with over a decade of experience, we're well positioned to provide robust yet simple services to financial institutions and others in the digital asset economy, services customers may not even know to ask for yet. And we continue to earn credibility and reputation in enterprise blockchain due to our expertise. For example, you could imagine a customer that has selected Ripple as the provider of their digital asset infrastructure, ensuring secure and unified digital asset operations. They might use Ripple to tokenize their real-world assets, bonds or money market funds, for example, and then they could store them securely via Ripple custody. At some point, they will need to liquidate a portion of those assets to fulfill other financial obligations. They might liquidate into a stablecoin like Ripple USD. That will then enable them to move those Ripple USD to any country they need to, then off-ramp and pay out those funds into a local fiat currency using a solution like Ripple Payments. The world is changing, and the financial rails that support global finance are about to go through another major evolution. Financial institutions need to leverage blockchain technology so they aren't left behind. Blockchain technology enables a new global network to move value fast, inexpensively, transparently, and reliably around the world. Financial institutions should focus on building the next generation of financial services for their customers. To make that possible, they need ready-to-go, simple, secure, compliant infrastructure to handle value movement, exchange, and storage on an enterprise-ready blockchain. Banks leverage our solution to transform their cross-border payments business into a revenue driver for them. With its simple, secure, compliant digital asset infrastructure, Ripple is best positioned to provide the core services that financial institutions need to tokenize, store, exchange, and move digital assets. Okay. Ripple's products are built to enable payment transparency. So we have security features built into those products that enable customers to comply with regulatory requirements across the world. Ripple Custody, for example, offers the ultimate level of private key protection, sole control over data and processes, scalable governance across all operations, and cold storage optionality to comply with global regulations. For example, we have strong traction with our payment solution, including hundreds of customers, lifetime transactions worth nearly $70 billion, and 80 plus payout markets around the world for crypto and fiat transactions. We've got 20 plus regulatory jurisdictions across 5 different continents where we support Ripple custody clients, which include leading financial institutions such as HSBC, Societe Generale, and DBS. And we've got extensive experience with financial institutions in emerging markets where crypto adoption is faster and regulations are clearer. Turkey, for example, with Guarantee Bank, and in the Philippines with UBP, and recently with Unicambio in Portugal as well. Since launch, RLUSD is available on 9 global centralized exchanges with 5 live automated market makers and decentralized exchanges and counting. So I'm going to talk a bit about the XRP ledger, which is the main blockchain ledger on which Ripple works. XRPL is a secure, cost-efficient, decentralized layer 1 blockchain intentionally designed for finance use cases that has enabled the tokenization and movement of value for over a decade. There are more than 100 validators which secure the network, and those validators are operated by universities, exchanges, businesses, individuals, and developers. 2.8 billion transactions have already taken place on the XRPL, representing over $1 trillion in value, moved between counterparties since the XRPL was set up in 2012. It's trusted and proven, institutional grade with decade-long reliability and stability, processing billions of successful transactions. And it also includes the world's first decentralized exchange, which aggregates all liquidity into one protocol, making transactions more capital efficient. Okay, so I'll give you an update on the RLUSD stablecoin. Ripple broke new ground last year, adding the RLUSD stablecoin to our product stack. The RLUSD stablecoin was issued in December last year, and launching a stablecoin was a natural step for Ripple to continue bridging the gap between traditional finance and crypto. We have the years of experience, the regulatory footprint, a strong balance sheet, and a network with near global payout coverage to offer the best of crypto-enabled payments using XRP and RLUSD together. So what is Ripple USD? It's a highly regulated, fully backed, transparent, and compliant tokenized dollar on a blockchain. It's designed to maintain a constant value of $1 backed by highly liquid backing assets, including cash and cash equivalents. And it's native to two different blockchain ledgers, the XRP ledger and Ethereum as well. The XRP ledger, as I've mentioned, has a number of key advantages, including high transactions per second, extremely low fees. The RLUSD stablecoin is issued through Standard Custody and Trust Company, which is regulated by the New York Department for Financial Services. So we have enterprise-grade regulatory oversight for the stablecoin, and that's a key distinguishing feature for Ripple's stablecoin. On the reserve management side, we have a combination of cash and top-tier liquid assets with multiple bank partners involved to mitigate the risk to the backing. We take a compliance-first approach. We have a weekly self-attestation of the reserves and also a public monthly attestation by a third-party accounting firm, which is published on our website. Several of those have been published already. And we're US domiciled. There's the highest perception of trust for the stablecoin. So just a bit of context about the stablecoin market as a whole. Stablecoin market capitalization has been growing fast over the last year. We see a market that's worth $230 billion today, and that has been projected to increase potentially to $2.8 trillion by 2028, given current market trends. So why is the stablecoin market growing so fast? What are the sources for demand? And what do we see as the key demand drivers for RLUSD? First of all, for cross-border payments between businesses. New and existing customers of Ripple's own payment solution can take advantage of the benefits that a stablecoin on the XRPL provides. That includes real-time settlement, network effects, and low transaction costs. Now, currently in our payments network, we use the XRP crypto asset, which is the native crypto asset for the XRPL ecosystem. In future, RLUSD will be available as well. So it's an additional option for our payments customers to choose. If they don't want to settle in an unbacked crypto asset, they're able to use the RLUSD stablecoin as well for more stability of value and an effective on-ramp and off-ramp to fiat. The combination of RLUSD and XRP as bridge assets for Ripple payments improves on the efficiencies of their network and provides an enhanced customer experience. Stablecoins play a really key role as on and off ramps to crypto. So if your money is currently in a bank account, you can then transfer into the crypto sector without loss of value using a stablecoin as your initial bridge asset into digital asset markets, allowing for a seamless transition to enter or exit crypto. We hear a lot about the tokenization of real-world assets at the moment, and we'll hear more about that over the conference today. Stablecoins play a really key role in that by providing liquidity, a settlement asset for trading and transactions in those tokenized RWAs, and collateral also for trading real-world assets. So what you see, for example, is people posting stablecoins as collateral in order to be able to secure leverage for trading of assets that are on-chain, whether that's crypto assets, tokenized bonds, tokenized funds, etc. And you also have portfolio and non-native use cases. So we're partnered with major centralized exchanges for trading of RLUSD. And we also have a targeted approach on major DeFi protocols to increase the total value locked on chain. And we also see non-governmental organizations receiving and paying out in RLUSD as well. So the update on RLUSD, this is as of the 20th of March, so just a few days ago. RLUSD was launched in December. We now have almost $170 million circulating worldwide. That's in line with the targets that the company has got. And it's fully backed by liquid assets, as I said. And in fact, the RLUSD stablecoin is over collateralized. So while there's 170 million circulating, we have 177 million approximately of reserves. So you have that over collateralization, which provides a buffer assuring the continued value of the stablecoin. But I think that although the value of stablecoins is often measured using this market capitalization metric, actually this can be somewhat misleading because stablecoins are primarily intended for payments use cases. And that means that people might just buy a stablecoin, use it for a payment, and then it might get sold again at the end of that payment. Okay, so it's not necessarily a store of value that people would hold. So you wouldn't necessarily expect a very large market capitalization. A much better metric for the use of a stablecoin, the size of a stablecoin, would be the volume of payments that are made using that stablecoin. Looking up just the other day, the RLUSD stablecoin is being used for $33 million of transactions every day. So it's seeing very substantial usage already. We're very pleased with progress on that. So that's all I had to say. We've got just a few minutes in case there are any questions in the room. I'm very happy to answer questions anybody's got. Go ahead. Yeah, thanks. That's a good question. So just in case people can't hear online, the question was whether there are any plans to become MiCA compliant. So RLUSD isn't offered in the EU today because MiCA requires a regulatory license to be able to offer stablecoins. And for example, the regulated exchanges within the EU to offer a particular stablecoin. We are in the process of seeking approval for the RLUSD to be able to offer it in the EU. I can't provide further details of that today, but hopefully we'll have that soon. So RLUSD is a dollar-backed stablecoin. So our first goal is to enable that to be used within the EU. But perhaps in the future. Any other questions? Hi. Yeah, that's a great question. So the question was whether RLUSD can interoperate between, with other stablecoins, for example, linked to other currencies. I think this is a really important sort of expanding area. So it could be, for example, in the course of a payment transaction, the payer wants to pay in a particular currency, the payee wants to receive a different currency. Today, that FX transaction might be handled by banks, but in future it could be handled instead by the conversion of a stablecoin denominated in one currency for a stablecoin denominated in another currency. You can already do this using our payments network. That's possible to do. We have other stablecoins circulating on the XRP ledger and usable within the Ripple payments network. But also, any individual can do the same thing using an exchange, either a centralized exchange or a decentralized exchange. You can use an automated market maker, including the one that's on XRPL to easily bridge across current stablecoins with different currency denominations. Yeah. Sorry, I couldn't quite hear the last bit. Yes. Absolutely. Yeah. Yeah. Yeah, I mean, I think it's a very interesting area because in the future you're likely to have 10 seconds left. In the future, you're likely to have transactions that involve, two currencies. So what you need is an efficient way to leverage the benefits of blockchain, being able to process that transaction in just a few seconds, but also managing that FX conversion within the course of the transaction. Yeah. I think that's it. That's all the time we have.
Thanks so much.
Thank you.
Okay, perfect. I really appreciate it. What really fascinates me about Ripple is how deeply connected you are to the financial system. You worked over 10 years, I think, in total at the Bank of England, amongst others, in payments policy. So you really know the system from the inside out. Highly appreciate it. Thank you. And next up, we come to the Eurodollar. And for this, we will be joined by Allan Pedersen and Cam Dillon, the CEO of Eurodollar and the Deputy CEO of Eurodollar. Nice to meet you. So please give it up for the two of them, and very happy to get some insights into Eurodollar. Thanks.
So how do I do the presentation? Do you just move forward or? Oh, like this. Okay, there you go. Hi, so we are from Eurodollar, and Eurodollar is a Danish company, and we're a stablecoin issuer. So we're an EMI license. We've been approved under MiCA and so on. So we will next month, hope, issue a dollar under MiCA, and there the month after issue a euro, and that's sort of the start of it. Well, we don't want to talk, I mean, we can talk more about this if anybody has questions, but otherwise today we wanted to particularly talk about quality in stablecoins, because we think that's actually one of the most important subjects for this particular coming year, because it's going to determine how the market is going to be split up between EMI, stablecoin issuers, banks, central banks, and so on. It's a very important aspect to discuss. So we would have loved this to be more of like a discussion, but it's very short. So we're going to run through it and see if we can take some questions and some discussion points with you guys, okay? So here is the key market really that we're all getting after, the $500 trillion of global financial assets. That is the size of it. If you go to FSB, Financial Stability Board, they have all the numbers you would ever want to know about what are the market sizes for just about any asset class. But the global financial assets are 500 trillion. All the transactions that happen there is, of course, much more than 500 trillion. But this is what the grand prize is for crypto, right? If we can move this on-chain onto new technology, that's where we want to see. That's where we believe that things will start changing. But what we also have figured out, I think, or what we seem to intuit now, is that that is not going to happen before we start seeing money of different kinds of quality starts coming on chain. So if the right type of money in sufficient quality is not on chain, these markets are not really an opportunity. So we've drawn it in this type of curve, which basically says if you take quality of money, and you can intuit the idea of money, we'll get more into it, but you can intuit the idea that some money is more money than others, right? A $100 bill is high quality money, and an IOU from me is not the greatest quality of money, even though, yeah. So that's it. But here's how we think of it at this moment. The real market size, if you look up, that's the y-axis, and then to the x-axis, we've got the quality of money. So if you think about some of the algorithmic stablecoins, some of the non-regulated stablecoins, we think the reality is that the market that they could access is actually not too big. That's what you can see here if you, well, you can see it, that's right. Basically here, right? And we think the first generation of the coins that are coming out now, which is the MiCA coins, also has sort of an end to it. We think there is going to be some sort of exponential curve where it says, oh my God, now it's all going to happen. But we're not there yet, okay? The quality is not quite there yet. Here in the other end is CBCD, right? That's the highest quality money. But which part of all this, what's going to happen in here? This is, we've put a little dragon because that's how you mark, terra incognita. That's the unknown area. We don't really know how this is going to play out. Is this going to be banks? Is it going to be new institutions? Is this going to be CBDC? This is very exciting and interesting. And we think thinking about that is something that makes sense. So let's just talk about money quality. What is money quality? Now, there is one particular scientist, Perry Mehrling, who's well worth reading. You can find him online, where he's explained the idea of a money hierarchy. So there's there's an academic side to this. But if we just think about it, we can think about the idea that there is like an emergent hierarchy of money. As in, basically, there are money that you would prefer in certain situations, and then there are money you would not so much prefer, right? As in, some people will say, in the crypto world, where is this like, we prefer USDC over USDT, or we prefer this over another. And it's always some sort of implicit idea of quality. We think one is more or higher quality than the other. The key part of that is that it's not a sort of a deterministic thing, it's an emergent thing, right? It's something that happens by all the interactions, by all the things that are being communicated. An order of money appears, and it's usually hierarchical, and it usually have central bank money at the top. Now, what we want to get, Cam will get more into this in later here, but all I can say is that we do know a little bit about what seems to be influencing where you are in this hierarchy, right? And those are the things that I've listed here on the left-hand side: safety of it, the liquidity, what are the use case. Because one thing may be really high quality money in one use case, but not in another. But the key part, I think, is that a lot of it's going to be determined by a number of different actors, as in people will look at lead use cases or lead users, and those are the ones I've sort of put to the right-hand side. The various financial actors, the rating agencies, the regulators, and experience, who will say, okay, this is high quality money, it can be used for this, or rating agencies, I have a feeling at least, that is going to be a big part of setting the stage for which money can be used for what, which then will reflect it again in regulations, as in you must be a AAA rated to be able to do certain things. Here is what we call, if you take this all the way through, you can think of this as the lower order money trap. So let's say you get stuck, as in you do not really feel that you need to improve your quality, but there are other in the market who continues to improve the quality of what they deliver. Well, firstly, you're going to face an opportunity ceiling, right? Because clearly there are now better alternatives, so you will never be able to become bigger than a certain size. That's the third part. The third part, the demand quality deterioration, is basically the mundane cases like trades and other things. If you have higher quality alternatives, that's where you will move. So if you stay there, you will also see a demand deterioration in terms of what are the quality of trades or quality of companies you're working with. And then the last part, which is an important one, which is that this curve changes depending on bull or bear markets. As in, when there is a bull market, you will find that people will use any kind of quality of money to get access to risk on assets, right? Because there are no risks in the market. You just need to be in the market. On the other hand, when there is a bear market, everybody wants to get to a safe haven. So the currency that you thought was okay is no longer okay. You want to move all the way up as close to the central bank money as possible. So that's near-death experiences for lower order money. So on one end, like if the quality keeps improving, those who stay where we are now, non-regulated, micro-regulated, as here in version 1, we will probably face this trap. That's what we think. Okay. Go to the next one. So where do we think it could end? Because this is sort of, as we all move up the quality chain, where should we get to? You can have your own opinion. I'm going to tell you what I could think or would hope to see, okay? I see, of course, the things we have here. What we hope to see is that all the people who are operating under MiCA and putting out very serious stablecoins will focus on high quality, developing safety, security, liquidity, all the things that you need to do to make sure that you are a good participant in this market and not just jump over the lowest bar. We hope that basically over time we should see that license to change to something like a tokenized financial institution or even a token credit institution that very likely will be able to produce money of higher quality than bank deposits. And we think can take a large part of it. Because the reality is that bank deposits and banks have plenty of problems, right? There's plenty of things to solve in the banking system. Fractional banking is not the safest place. Deposit insurance is not the right thing. You cannot have a place where heads we win and tails taxpayers lose. That system will not work in the long run. I think, honestly, the ECB and others will take the chance to use these, as you can already see now, these digital euros and these licenses that are coming out to help do what we would call a market-led renovation or improvement of basically the overall financial markets. We all know that the financial market union has not been quite as good as it should be, and bank loans are way too big in terms of financing in the EU. So we think this is where we could go, but it requires that we continue to focus on quality, and that's sort of to come to tell us a lot more about that.
Yeah, thank you. So with all of that in mind, we've sort of come up with what we think is Eurodollar quality and how we want to build within kind of the Eurodollar system. So with that, we kind of, as an early participant, because the industry is still relatively young, we look at, well, where did it all start? We've seen kind of a lot of stable coins today have emerged out of a decentralized environment, which has been largely unregulated. And that's meant that the reserves have been opaque, governance perhaps not quite what we would expect to see, like we would see in TradFi. And that's given rise to single currency domination in the stablecoin industry, and that is the US dollar. That's kind of the reality of what the landscape is today. And also that there are limited use cases. So stablecoins to date have very much been used for crypto asset trading as a safe mechanism to move in and out of higher risk crypto assets. And so with the introduction of MiCA, that's kind of changing the landscape, we think, for the better. And we're very much leaning into regulation. So I think MiCA is a really good starting point and is a massive opportunity for Europe if we harness it. And I think there's, time will tell how that evolves, but it's certainly an opportunity in our view, and that can lead to things like responsible reserve management, because now we're a supervised industry, taking the principles of governance that we've seen established in TradFi, because there are very kind of good practices that have been established that we can now move into the blockchain kind of environment. And we also therefore believe in diversification, both in terms of currencies. We believe in a multi-currency approach, as well as roles. And we see that in TradFi today also. There are very clear kind of roles and responsibilities. Even though we see some actors doing multiple roles, there are still kind of clear parameters around who is responsible for what. And that all feeds into a kind of a diversified environment. And we think that creates an environment that's a lot more robust. And that will be quite critical, I think, to taking financial assets or the financial system rather on chain. So then we, Eurodollar we've got our license under MiCA. We are issuing a US dollar pegged stablecoin to start with. And that kind of comes to the point that we're building in a current reality, but we are also building for the future. So that's why we started with a US dollar pegged coin, but we will look to issue stable coins pegged in other currencies also. And the next one we expect to launch is a euro pegged stable coin. So we think with that, we will see the emergence of a new type of actor, and Allan alluded to that earlier, of tokenized financial institutions. There will be a role for central banks, in our view, as well as the commercial banks, but we think that there will also be kind of a newer role for these TFIs who really focus on stablecoin issuance as a role in and of itself. Because what we see, so like 3 core categories that we've worked to build to a very high standard are technological and operational, so bringing kind of the advancements that are offered by blockchain. Just move into this one, the advancements that are offered by the blockchain and integrating that with the security standards that we would see in traditional banking systems. Legal and compliance, or regulatory and compliance, that's where the oversight, having a compliance framework that is robust, kind of comes into play, and we've sort of built an entire framework around that. And perhaps the most important, prudent financial management, because as we see the sector grow, we expect to see kind of, the numbers are already pretty high. So we're talking today, we're looking at a $220 billion industry. We expect that to kind of grow quite exponentially. And I think we saw some numbers from Ripple earlier. So that means that the kind of prudent financial management that's been done by these newer players becomes really kind of critical. And that's around issuances, redemptions, and ultimately reserve management, and the transparency that I think we perhaps haven't seen today improve significantly. So with that, as I've already said, Eurodollar is issuing a US dollar stablecoin. On the other side of it, we are also issuing a money market bond, which is essentially a financial asset that is designed to perform better than, say, an average tokenized money market fund in the traditional system. And that's kind of our other side of seeing the financial markets go on chain, because we really believe that this is a new wave of modernization of the financial system. And I think there are a lot of efficiencies to be gained by using the blockchain to do that, really. I think that's what, do you have any final words?
No, thank you.
Conscious of
because there's like time.
Yeah, exactly. Does anyone have any questions? We're happy to take questions.
Okay, so I'll take the one on the banking side. So there is this idea that a key part of what the banking does is a transformation, right? From deposits to long-term lending. So we make sure that there is if you don't have that, then the economy breaks down, you don't have growth capital, and so forth. Now, the reality is that that's not quite how it works anymore. For most markets that are very active, the wholesale funding market and the market is actually where a lot of the funding happens. And in fact, in a place like Europe, there's too much of a banking loan dependence, and it should actually be quite different. You can see it in most of the ECB reports as well. So we don't see that as big of a problem, that you would stop that, because as I said, if you saw the curve, hopefully you saw that it was two, it was both, that both should have a role. So we don't see that as being something that will stop the lending. What we see is hopefully it'll make a more market-based lending system instead, which is really where the US and those who've done quite well with innovation sit today. So we're not so worried about that. But that's a very big political, I mean, this is way above my pay grade. So this is a very political thing.
I think on the, I was just going to say, on the roles question there, so I have slightly what might be seen as a perhaps slightly controversial view. So so in terms of the banks, for example, I think stablecoin issuers emerge as a role and a player in and of themselves. We're seeing already some that are very close to institutional level if we just look at numbers. I think there's a business model for stablecoins just in and of themselves. It's not a product. I think oftentimes stablecoins can be seen as a product. So we get certain bigger players who think, okay, fine, we'll just issue a stablecoin. But actually, it's a whole business model in and of itself. And I think for mass adoption and growth, I think regulation is a really big and important part of that. But with regulation comes also the recognition of what this role looks like. So I do actually think there's a place for kind of newer institutions, to call them institutions, is they've come out of kind of much smaller players where you see huge amounts of innovation and entrepreneurship. And I think because stablecoins are built on very new technology, I think larger players are better off perhaps even partnering or joining up with the smaller players that are really innovating in the space, as opposed to trying to create a stable coin as just another product, because I don't think it is. I think it has an entire business model, an entire kind of own responsibility.
We're over time. So thank you very much.
Thanks. So perfect. Thank you so much, Cam and Allan, for this fruitful presentation. Yeah, give it up for them one more time. I hope you'll be around. I think there might be some more questions to be addressed at you. Coming to the next point. So now we have a little networking break. So grab a coffee, exchange ideas, and then we'll see you later at 11 here for a retail CBDC discussion led by John Kiff, or at 10:50 in the Audimax main stage for another panel discussion. Thanks.
Dear ladies and gentlemen, welcome. Our next guest, he brings decades of experiences from the IMF and the Bank of Canada, and he has dedicated himself towards the topics of CBDCs, financial innovation, and fintechs. Please welcome John Kiff.
Thank you. All right. It's going to be a real challenge today, fitting all this into 20 minutes. I usually have an hour or so, so I'm going to be flashing by pretty quickly. Normally, I like to say, invite questions along the way, but let's wait till the end and see if we have time for that. It's going to be really tight. Okay, so, and if you have any questions, here's my contact information. I go by the name Kiffmeister. I'm very easy to find on LinkedIn, X, or wherever. So if you have any questions or you want the copies of the slides, I will give those away to anybody that wants them. So in terms of growth industry, it's not bad. When I started watching CBDC, that would have been around 2017 or so. There's maybe a dozen or so central banks that were exploring CBDC. Now we have 105 or so. And we're talking specifically here about retail CBDC. Wholesale CBDC is just a whole other topic. So we're talking retail here. You'll notice there's been kind of a flattening out, but that's probably natural as you're reaching the saturation point of central banks that can issue CBDC, right? There's only so many countries out there. So I think we're reaching that saturation point. All of this is based on publicly available information too. I'm kind of a stickler about that. Some central banks in privacy do tell me about their efforts, but they don't want to keep it. They want to keep it private. It doesn't go into my database. So in terms of definition, first of all, we're talking about retail CBDC or general purpose CBDC, which is in the highlighted bit at the bottom. But some of the information on this, what I call money onion, is quite relevant here. And near the top, there's a definition from the BIS where it's the CBDCs defined as the digital payment instrument denominated in the national unit of account that is this direct liability of the central bank. And we have to be real sticklers about this because there's lots of things that are proposed that kind of sound central bank digital currency-ish, which are not. And being part of the CBDCtracker.org group, everybody wants their product to be on that database. That we're kind of famous for that. So being pitched CBDC frequently that are not CBDC. And as examples, we've got Palau, an island in the Pacific. They're a US dollar-based country. They don't have their own currency that's in use. So in their case, the government's planning to issue a stablecoin, and sometimes that's characterized as CBDC. But Palau doesn't have a central bank, so it can't be a central bank digital currency, and it's really just a stablecoin issued by the government. In Cambodia, they've got this project Bakong, which is essentially a fast payment system that's run by the central bank. The central bank's not issuing any tokens or anything like that, so that's not a CBDC either, even though the World Economic Forum at one point did call it a CBDC. Then there's this funky one that the nerds at the tracker argue about all the time. Zimbabwe, they introduced something called the ZIG. That's Zimbabwe gold, and it's a digital currency backed by physical gold, and it meets much of the criteria for a CBDC. That's going back here. I mean, it's a digital payment instrument denominated in the national unit of account, and in the case of Zimbabwe, they intended that ZIG to be used for transactions and so on. So it was a unit of account, arguably. And it was a direct liability of the central bank. So, that's one I'm not sure about. I still have a warm feeling in my heart that this is possibly a CBDC, but the tracker colleagues don't agree with me, so it's not on that list. But you can see that it is often gray zones in this definition. So in terms of who's doing what and why and so on, this is my tabulation of motivations, and I like to divide them into emerging market versus advanced economies. Emerging markets tend to focus on things like increasing the amount of digitalization in the economy, financial inclusion. Many of them are very concerned about the physical cost of cash. I mean, there's economies of scale in producing and managing cash, and so for small emerging market countries, that can be quite a burden. And so a lot of them will cite that as a reason. Another one that's important, didn't highlight it, but preserving seniorage revenue, because as people reduce the amount of cash they use, that actually creates a loss of revenue of central banks, because on a central bank balance sheet, currency like cash appears on the liability side, and it's offset by an asset item, which is investments in typically government bonds and so on. So for many central banks, this is how they fund themselves. If they don't issue any currency, they don't have any revenue, and they can't run a central bank anymore. So preserving seigniorage revenue can be particularly important for emerging market economy central banks. Another one is reducing currency substitution, and that just means, like in many cases, we're talking about dollarization. So a country that's been hit by extreme dollarization, they want people to use their own currency so they can actually perform monetary policy, which you really can't when you don't actually control the currency that people are using. They're hoping that magically that the CBDC will mean people will start using their currency rather than the dollar. But you can, I'm skeptical. You're just changing the medium. Not the reason why people are using dollars isn't because they're digital or they got nice colored banknotes or anything. It's just there's fundamental reasons for that. So I'm kind of skeptical. Advanced economies focus on the cash usage decline too, and again, it's kind of it's not usually motivated by the same things as the currency substitution gang is worried about. But in the case of advanced economy central banks, they are concerned that their ability to do monetary policy is being undermined by the fact that nobody's using the currency of the nation anymore. And plus, it kind of relates a little bit to monetary sovereignty. And I didn't update the slide yet, but the ECB talks a lot about strategic autonomy also, and they kind of relate. And so it's the central bank may consider issuing CBDC because they want to have control over their money systems, and that includes things like, in the case of Europe, the ECB is concerned about the domination of the big American payment firms, Visa, MasterCard, PayPal, and so on. And so that's high on the Eurozone's list of motivations. And just generally improving payment system efficiency, competition, and resilience, and safety. And these are all things I think every central bank should be concerned about, staying current, using the most current technology in the production and distribution of money. And there's a whole bunch of other things I don't have time to jump into. I'll touch on them a little bit when we talk about design features. But cross-border payments is one that is one that many aspire to. They want to have a retail CBDC that can be, say, interoperable with CBDC of other countries. So far, that really hasn't happened much in the retail CBDC space. I see it happening more in the wholesale CBDC space. That seems to be where the main action is. And also, when I go to CBDC conferences, people are talking more about instant payment systems, which are a lot easier it seems easier to interoperate with other countries' instant payment systems to solve this cross-border payments problem. But like I say, it's at the bottom of my list. I highlight it because they all say this, but they're all put in the plans to actually do that on the back burner because it's so difficult to do. And so now I'm going to get into who's doing what. And I base my thinking on the IMF's so-called 5P approach to CBDC project management. And so they see this process in 5 phases. First of all, the central bank starts with the preparation phase. And that's where the ECB is right now. And that usually means research and making sure that you've got the high-level policy designs right. You're not, at this point, you're typically not playing with technology. You're talking about design principles, and so on. And then after that, you move on to proof of concepts, and that's where you get into the technology. In some cases, you do some sort of lab experiments with the CBDC, a hypothetical CBDC. You might be contacting different vendors and trying their software out in sort of a controlled environment. And sometimes it goes as far as actually launching a prototype, which is not the prototype stage, but a prototype CBDC that they will often try with their staff. The Central Bank of Ukraine did that some years ago, where they had a prototype CBDC that they tested with their staff for about 6 months or so. That's a proof of concept. Then you move to a prototype. In that point, you're actually decided what kind of technology is your best bet, and you build a prototype. Then you move that into a pilot phase, and that's where you're actually sending the CBDC out into the wild with real users, but you typically in a limited way, either limited in terms of demographics or sometimes usually limited in terms of time, like in the case of the in China, for instance, they've got a massive pilot going on. In fact, it's a pilot it's pilots within a pilot. They're trying all sorts of different things in different towns and regions, testing out different types of software and so on. In fact, it's so mind-bogglingly big and complex. I have trouble actually just figuring out what's being done and where. At one point, they were apparently using or testing a distributed ledger technology-based platform. Then later on, they say, no, that didn't scale very well, so they switched to a central database. I don't know where they are today, but they're moving fast and trying lots of different technologies, and those are pilots. In some cases, the pilots came and went. Uruguay had a pilot that ran for about 6 months also. It was very successful, but they right from the start, they committed to doing just 6 months of piloting, and then they stopped to review it, and they've been reviewing it for some time since then. I'm not sure where their current plans stand, but that's a typical time-limited pilot. Then after that, there's a possibility of going to production, and that's when you launch it for real. It's no longer an experiment. Doesn't mean that you see in these little arrows that, in fact, there's some iteration. Each stage you might go back, because suppose you get to the pilot. Pilot doesn't work. You may go back and try a different prototype. You may even get to the launch point and decide, oops, something's not right. We need to go back and maybe build another prototype. I think Nigeria, which is another, that's a country that's launched a CBDC, are going through this iterative process all the time, and that's the right thing to do. If something's not working, fix it. And so then we've had. That's a slide I need to jump over. So I do on my website, Kiffmeister.com, I publish a monthly tabulation of all the different efforts out there that, and it categorizes them in a similar way to those 5 Ps I just mentioned. One I don't include is prototype, because I can't detect when a prototype is being done. It's whatever's happening between the proof of concept and the pilot. But you can see here that we've got 3 to 4 launches, and that's 3 to 4 because of that ZIG, the ZIG I mentioned before. If you don't think ZIG is Zimbabwe ZIG is a CBDC, then you're gonna be in the 3 camp. I'm still warm to 4. So there have been 12 pilots, and then there's been 21 proof of concepts and prototypes that have been run out there, and then the vast majority the 68 are doing research still, and that can be I don't have any way of really defining any finer than that. So in many cases, it's probably just desk research. Some economists at the central bank are writing some papers and doing an investigation of CBDC. In other cases, in that big 68 group, there's countries that have or central banks that are quite advanced, but I can't measure that. Central banks are notoriously shy. I mentioned before how some of them told me, yeah, we're doing CBDC work, but do not include it on your table when we don't want anybody to know about it. So they're similarly shy about giving you updates. I mean, some central banks are really good, like Bank of Israel, Central Bank of Kazakhstan, and the ECB too are really good at sort of keeping citizens abreast of what they're doing, sending out white papers and frequent social media updates and so on. So the quality of the information can vary. And this is the view from the CBDCtracker.org, which I'm also a part of, and so that has this, it's got a map. That's the front end, so you can see who's launched, piloted, proof of concept, research, and then there's many that have canceled, and there's 2 I'll show you in a minute that launched and canceled. So in a way, the actual number of launches is not 3 to 4, it's 5 to 6, but they canceled completely. But you'll see that blue is launched, and you have to zoom this out in a really big way to see it because they're very small. But you'll see the biggest, we've got some big pilots out there like Russia and China, but there's a lot of green in there too. So these are the ones that are fully launched. You got Nigeria, Jamaica, and the Bahamas, and that's it right now. And that's interestingly that the last, I don't know which one, forget which one it was, but the last launch was 2023. So in that chart I showed at the beginning that showed the rapid increase and then the flattening out. If you looked at the number of central banks moving into the really serious stages, like proof of concepts and pilots and so on, that seems to have stalled and maybe even gone backwards. Many central banks are pivoting towards wholesale CBDC and tokenized deposits and so on. So we're kind of on the cusp. Like if I'm doing this presentation here next year, I think I'll be showing you a different picture completely, and that curve will flatten. Maybe even if I start including cancellations, it's going to be dipping down. And these are the ones that canceled. We got Ecuador. They were active from 2014 to 18. And Finland, they actually launched a CBDC back in 1992. But then active for about 13 years. The last few years of it, actually, they transferred it over to the private sector. So they kind of eased their way out of the business. But neither of these two efforts got much uptake. The number of people actually using it was pretty small, so you'd have to call them canceled and failures. So in terms of key design characteristics, first of all, no central bank runs the whole show from beginning to end. They issue the CBDC, but they partner with the private sector players to actually distribute the CBDC and so on. And in terms of transaction fees, so far in the pilots and launches, transaction fees aren't being charged, but I can see that might be the case eventually. Someone's got to pay for this effort, but chances are it will be merchants that will pay, but they will be charged transaction fees that are far lower than what they currently pay to the Visas and the MasterCards of the world. And then there's some talk about central banks maybe compensating intermediaries too for their role and that might be important because Nigeria is one of the countries that launched and it's not going very well. And when I talk to commercial bankers there who are they're the intermediaries being called on to distribute the CBDC, they're not very pleased. They were asked out of the blue to distribute and manage a CBDC program. And they're not being compensated for it at all. And in some cases, the CBDC threatens to eat their lunch, basically, because people might transfer out of commercial bank deposits into CBDC. None pay interest, and that's because of that fear of creating a CBDC that's too much like a deposit, which would lead to possibly people draining money out of their commercial bank accounts into CBDC, which could have important repercussions for the bank's ability to lend. And so there's a big concern in the CBDC community. The central banks do not create a CBDC that's so attractive that it disintermediates banks in that way, which is why they usually apply limits to the CBDC. So people can't dump all their money into CBDC. And that's a particular issue when there's a bank run. You don't want to have an easy way for people to basically drain the banking system into CBDC. And the other way that the limits come in is that you'll see what they call tiered limits for AML, CFT purposes. That in order to have a high holding limit on the CBDC, you have to have really intense KYC done and so on. And whereas they often offer a lower holding limit for people that want more privacy, and so the limits are very low, but they don't have to, often all they have to ante up is a telephone number and very little other identifying information. Non-programmability, smart contracts is discussed, but nobody's done that, and that's probably good reason. There's a big lobby group out there that thinks that this is the end of the world. Like programmability means that the central bank can control how you spend, what you spend it on, and so on. And that's left is from my old company, IMF. They were saying, yeah, this is a great thing. We can do wonderful things with programmability, but on the other side, you've got these lobby groups that think that this is going to be the worst thing. In terms of platform choices, some people might think that CBDC is based on distributed ledger technology. No, that's not true at all. You'll see here that some are and some are not, but the ones that use DLT are generally using private permissions. It's kind of almost like considered a bad practice to use an unpermissioned public network. I disagree with that, but that's the current thinking. And then some are contemplating offering an offline CBDC. G&D prototyped one of these in Ghana, and they did it in Thailand too. And I've just run out of time. I just put this up here because there's I want to address the underwhelming demand problem, and this is part of it. That I think some central banks think we build it, everyone's going to love it, they will come. Well, not so. It's not working out that way at all, and there's various reasons for that. And I touched on some of them earlier, like compensating merchants or lower fees from merchants, compensating intermediaries. There's lots of reasons why demand has been rather underwhelming. But if anybody wants to talk more about that, I'm available after the session. We can discuss the underwhelming demand problem. Thank you.
All right. Thank you, John Kiff, for this insightful presentation. We'll now turn to the Digital Euro Association's Thesis Awards of 2024, where we celebrate cutting-edge research on CBDCs, tokenized deposits, and stablecoins. I'm pleased to welcome our outstanding award finalists, and excuse me for the name pronunciations, Abdurrahman, Aydinhan, Michael Dours, and Willem Vicent.
Okay, great, everyone. Welcome to the Digital Euro Association Thesis Awards. Feel free to stay. There's going to be quite a few interesting presentations by very young and brilliant minds, as it were. I'll just let John and his colleague sort that out. All right, so if I skip ahead here. My name is Conrad. I am a strategic advisor at the Digital Euro Association, and I am privileged to be introducing you to our finalists today. They submitted their theses last year, and we went through a rigorous process of judging those theses, and these three emerged as the top theses finalists. So the DEA, maybe some background about the Thesis Awards. The DEA launched these awards 3 years ago as part of some of one of our three core pillars. The first being education, of course, under which the Thesis Awards is lodged. We also have a pillar on community and collaboration, and then also public affairs. And of course, most important of these three is education, because moving and making meaningful progress in the digital currency space is highly predicated upon educating not only the average person on the ground who are the users of digital currencies, but also commercial banks who are intricately involved in the distribution of central bank digital currencies, for instance, and maybe other forms of digital money, but also regulators at the highest level. We found that many of the regulators and issuers of certain currencies require education on these topics, and our finalists today have put forward very important pieces of work and contributions towards the literature to move the needle in that regard. Maybe just some background in terms of the review process. The three finalists stood out for their originality of work and thought, relevance to policy and market development, analytical depth and clarity, as well as the potential for real-world impact. So we felt that these were quite important in terms of making sure that they aren't just theoretical, but also that they have some practical application. So each of our presenters today will have a 15 to 20 minutes. We do have a bit of a buffer at this stage, so we'll allow a little bit over 15 minutes if required, and after which we'll announce the order of winners in this regard. So without further ado, let's begin. I would like to introduce our first Thesis Awards finalist, and that is Willem Vicent. He is from the University of Twente. I think, I hope I'm pronouncing that correctly.
Yes.
And his thesis is entitled Quantifying the Impact of the Introduction of a CBDC by the ECB on the Dutch Banking Sector. His analysis provides a practical lens into how central bank digital currencies interact with commercial banking models and what risks or safeguards should be in place, including holding limits. And with that, please help me welcome Willem.
Yes. Well, hello everyone. Nice to be able to present my thesis here today. My name is Willem Vicent and I'm from the Netherlands, where Vicent is actually also a first name, so that's often very confusing. Let me dive into it. So I will talk a bit about what I did during my research. I will talk about the model I made. I will talk about scenarios and the results, and I will give a brief conclusion. Please keep in mind that this is a really shortened version. So if you're very interested in it, you can always read my thesis. So I will dive straight into the research question. So in the beginning of my research, I started with the question, what would be the potential financial impact of the introduction of a digital euro on the Dutch banking sector? So, and immediately we found out that that was quite a difficult question. So we identified three main impacts. So we identified impact on financial intermediation, which is that deposits might go to a digital euro account, which means that banks cannot lend out these deposits anymore because they are now on the balance sheet of the central bank, which leads to lower net interest income. Also, we identified that there might be impact on payment services. And yeah, payment factories of banks often have really high fixed costs, while their revenues, their marginal revenues are high per transaction. So if you lose transactions, that can lead to severe impact for a bank. And also, of course, for a bank, there is quite some development costs surrounding the digital euro. Well, during this research, we found out that the last two were quite hard to quantify. So we focused mainly on the first part, and we made a model to estimate the impact. So now we'll tell you a bit about this model. And here you see a simplified balance sheet of a bank. And banks, of course, get deposits from their clients. And they use these deposits to make loans, and we call that financial intermediation. But banks cannot turn every deposit into a long-term loan because they also need to hold high-quality liquid assets, so kind of a form of cash. And how much they need to keep on their balance sheet is determined by liquidity coverage ratio, for example, and net stable funding ratio. And from this point on, it's still quite hard to identify the real impact. So we had to make a lot of assumptions. Well, the first important assumption that we made is that banks react to deposit outflows by reducing their high-quality liquid assets, so kind of their cash, as much as their liquidity ratio and their net stable funding ratio allows. And otherwise, they will attract long-term wholesale funding. What we did for this analysis is we aggregated the balance sheets of the four biggest Dutch banks, which represent more than 90% of the balance sheet total in the Netherlands of banks. And we modeled them as one model bank, like representing the Dutch banking sector. Also, an important assumption is that banks do not raise their interest rates to obtain additional deposits. Also, the model is static, so we used data of the 31st of December 2022, which means that this assesses the impact of what if the digital euro would have been introduced the 31st of December of 2022. Also, we assume that operational input is constant while deposits leave the bank, so that means that no people get fired because there are now less deposits at the bank. So the costs stay constant. And we have made quite some more assumptions, but we will not go into that due to the time. And how does that look? Now here you see the simplified balance sheet of the bank before the digital euro. So you can see the bank has sufficient cash. It's above the limit. So the dotted line is the liquidity coverage ratio. And you see that after the digital euro is implemented, the amount of cash is limited to the buffer and the gap is filled with wholesale funding. Well, this is then how that model looks for the input parameters. So what did we do? we fixed the input parameters for the bank and we fixed the input parameters for the market, but we started conducting scenario analysis on certain deposit outflows. And that led then to certain results, which we now go into. So we looked at four different scenarios. So the first scenario we looked at is, what if people use the digital euro as a buffer? So kind of like putting cash in a sock. They put, for example, 500 euro on a digital euro account one time and they never look at it again. And for the rest, they use the waterfall functionalities to pay with the digital euro. Then we looked at, what if people start using the digital euro as a means of payments? So what if people use the digital euro to do their variable expenses and fund their account per month? We assume that it's funded per month and then linearly defunded, and we base this scenario on CBS data, which is the Dutch statistics agency. Then we also looked at, what if people use the holding limit to the full extent, and we assumed here a holding limit of 3,000 euro. And we also, in even worse case, we looked at, what if people and businesses use the digital euro to the full extent. So before we go to the results, it's important to remember that we used a lot of assumptions. So these figures should be interpreted as an order of magnitude and not as real impact. Also, during this research, we made use of outside-in estimates. So there's no Rabobank data involved. Well, they allowed me to do my thesis there. There's no Rabobank data involved in these results. Furthermore, in the results, the adoption point of 49% is shown. And this point is based on the research done by Belsma, who researched how willing Dutch people were to open a digital euro account. And he found out that it would be around 49%. So then if we go to the results, here we can see the total deposit outflow based on my scenarios. So it's important to note that the deposits totals for 2022 were 1,336 billion. So for the first scenario, if you would have 100% adoption, so this was the scenario where only a buffer is used, and if everybody does that, 7 billion euros flows out of the Dutch banking system, which is equal to 2.5%, which is quite limited, I would say. Also, if you look at the worst case scenario, so scenario 4, so that is if businesses use the holding limit to the full extent, and if private individuals do that, and you have an adoption of 100%, you see 51 billion euros flow out of the Dutch banking sector. And this will be equal to a total of 3.5%. And then if we convert that to earnings, we can see that total earnings in 2022 were 9 billion. And for the first scenario, 136 million euro will flow out around percent in case everybody does it. And then in the worst case here, it's a bit more than 10% or 900 million euro if everybody adopts the digital euro and uses it to the full holding extent. Then we also looked at how does this impact the liquidity ratios. So you can see that the model bank, so the aggregated balance sheets of the Dutch bank, started with a liquidity coverage ratio of 152%. And it would only drop 2% in the first scenario by 100% adoption and around a bit more than 14% in the worst case, still being a lot above the legal required minimum of 100%. We did the same analysis for the net stable funding ratio with a lower starting point, but you also see that the impact here is lower, so the decrease is lower. Well, also if we look at these results, it's also maybe important to to think about how likely actually are these scenarios. Well, as the ECB pointed out, they want to develop the digital euro as a means of payment and not a store of value. And actually, the Dutch National Bank thought that the digital euro as a buffer would be the most realistic scenario, or even before that. So even less deposits put on the digital euro. Well, then if we look at using the digital euro as a means of payments, and then you're quite dependent on how will the waterfall functionalities work. So if they don't work very good, this might be more realistic. But it's also important to note that funding and defunding is quite inconvenient, and that if you get a salary of 3,000 euros, yeah, then or if it's higher, then it's already hard to receive your salary on the digital euro account. Also, if you look at the stress scenario, where everyone puts the whole holding limit on the digital euro account, it's also quite unrealistic, and only maybe in a really stressful scenario. And then even it's also very important to note that if you look at Dutch statistics, not every person even has 3,000 euros on their current account. Well, and for the last scenario, that would be the absolute worst case is if also businesses could hold digital euro. But at the point I was writing my thesis, it was quite unlikely that businesses were able to do that. Something else which is interesting is that for none of these scenarios, which we not necessarily expect beforehand, that there was no wholesale funding needed for any of these scenarios. So then we look now, when do we need additional wholesale funding to stay above this high quality liquid assets limit or cash limit? And we found out that every Dutch person above 15 could put 11,701 euro on the digital euro account before the liquidity ratio of the model bank was breached. On the earnings, it's very important to note that it's very dependent on the interest rate environment. If you look at 2021, where deposit facility rate at the European Central Bank was negative, it was actually beneficial for banks to lose deposits. Well, if you look at 2023, when the spreads widened, it was also more expensive to lose deposits, but the earnings rose as well. So if you look at the percentages, which I did, the percentages stayed almost the same. Well, and then we come to the conclusion. I hope I'm not over time. Well, the first conclusion is that financial disintermediation due to the introduction of the digital euro poses a manageable risk to the Dutch banking sector. And by that, I mean that it is not life-threatening. It's important to note that the risk of financial intermediation is maybe already present due to stablecoins. So that's also another argument you could make here. The second conclusion point is that every Dutch person could put 11,701 euro on the digital euro account before the liquidity ratio of the model bank is breached. And it's of course very important to note that every bank has different liquidity ratios. But in my scenario, for none of the banks, additional wholesale funding was needed based on these scenarios. And I think that Dutch banks are quite similar. If you look at German banks, where there are a lot of smaller banks there, it might be a bit more tricky, for example. So the third conclusion, we just touched upon that the impact on earnings is highly dependent on the interest rate environment. And the last conclusion, I didn't go into that for this presentation, but in my thesis I also went in a bit on the impact on payment revenue, and it's not and development costs, and it's not necessarily given that financial disintermediation will be the biggest risk. It can also come from the impact of payment revenue, of course, depending on the remuneration per transaction or on the development cost. So that was my presentation.
Thank Thank you, Willem. Very insightful, of course, and quite rigorous study there. Next up, we have Abdurrahman. He is going to take us through his thesis, which is entitled The Demand for Central Bank Digital Currencies in Decentralized Finance. Quite an interesting topic, in fact. Abdurrahman's research examines the growing relevance of tokenized CBDCs in the world of decentralized finance. He challenges the role of stablecoins, exploring whether a public-private model of tokenized CBDC could offer a safer, more legitimate monetary tool. Could you please help me in joining, or rather welcoming Abdurrahman to present his thesis?
Thank you very much for attending today. It really means a lot to me that you're here because this is a topic I've put a lot of thought into. And so I have a question, and the question is, can we rebuild trust in the financial system? Because there is this growing inequality which always stayed in the back of my mind when I first started my university degree in economics. And during the first year, I had this course called Business Ethics, where we discussed the financial crisis. And I watched every financial movie, like Margin Call, Big Short. And I was angry that a small group of people could benefit of the rest of society during a time of crisis. So that was also around the time when I just found out about Bitcoin. And I thought, okay, this is the solution, but I could not have been more wrong. Around that time also, Ethereum had just launched, the ICO boom was in full swing. And when it all came crashing down, nobody believed, at least everybody believed, this technology is not going anywhere. But I stayed strong in my conviction, and I did continued doing research every day. And that's when the decentralized finance boom happened. Suddenly, I could use my magic internet money to gamble and play in this 24/7 online worldwide casino. And it reminded me a lot of my youth when I used to play a game called RuneScape. It's a game where it's a massive multiplayer game where a lot of people are thrown into this world, and we all did all kinds of economic activity. And when the time came to write my graduate thesis, I knew I had to write it about crypto. But I thought, because I was so deeply involved in the industry, I thought I already know everything, but I didn't know this thing called central bank digital currencies. And I thought, aren't stablecoins and CBDCs the same thing? So that's what I head out to explore. And later, after my graduating, I started working at the Dutch Payments Association as a digital euro policy advisor, where I worked with the Dutch banks and the Dutch Central Bank on the implementation of the digital euro in the Netherlands. And and when I was writing my graduate thesis, of course it was, I did finance, so it had to be empirical research. And in this, the first variable that I collected data on is called the crypto GDP. And you might think crypto is all speculation, but from I found there is actually productive activity happening within this economy. And due to limited time and resources, I have only collected data for 3 sources of income within this economy. And the first source of income is within this new digital economy is Bitcoin and Ethereum mining profits. Here you can see the price of Bitcoin and the amount of Bitcoins being mined every day. If you just multiply it, you have the total amount of revenue earned by all miners within this economy. And you can do the same for Ethereum mining. And the second source of income within this economy is called wages earned by blockchain developers. And I just multiplied it by the mean average wage of a software engineer and the amount of blockchain developers. And the third source of income within this crypto economy is yields earned by decentralized finance applications. And here you can see right now there's approximately $100 billion worth of assets in these financial applications. And to be sure, is everybody here familiar with what decentralized finance is? Please raise your hands. I see some hands. So nobody else knows what decentralized finance is? You do? Okay. Could you please explain it? Yeah.
There isn't intermediary. There's B2B business, BDC. There isn't a counterparty risk. Smart contracts.
I'll give my explanation as well. Decentralized finance application is application built on top of Ethereum or on Solana. And users all around the world can send their Bitcoin or Ethereum or stablecoins to this application, and other users can trade against it like an exchange or borrow or lend from it. And they pay a fee for this, and this fee is paid out as profits to these applications. So now that we have established that there are three sources of income within this crypto economy, so mining profits, wages earned by developers, and yields earned by decentralized finance applications, I have found that this creates a demand for money. And when Facebook said, we are going to satisfy this demand by releasing a stablecoin, regulators all around the world immediately rushed to shut this project down, and shortly after, which they did successfully, and shortly after introduced their central bank digital currency projects. And important to keep in mind with stablecoins is that the key difference is they have 24/7 instant settlement, have no borders, and is accessible for everyone with an internet connection. One minor setback is that the Bank of International Settlements does not recognize stablecoins as a form of money because of frequent peg failures and redemption uncertainty, which undermines their reliability as a store of value. But this has not stopped stablecoins from having explosive growth. Right now, there are $200 billion worth of stablecoins outstanding. And right now, there are $200 billion worth of stablecoins outstanding. And this means there's no new money being created. It is simply deposits flowing from fractional reserve banks into full reserve banks, where the liquidity is locked and can't be accessed for making new loans. And does that sound familiar? It's exactly what the digital euro legislators fear with regard to the holding limits. Here, what you're seeing with the growth of stablecoins is money flowing out of banks. And the liquidity is locked. And that's exactly what we fear with the digital euro. So you might think, where does this theory come from? And it is based on classic economic theory like from Irving Fisher and John Maynard Keynes, called the quantity theory of money, which states that if there's economic activity, there will be a demand for money to facilitate transactions and support economic activity within this economy. John Maynard Keynes later came up with the money demand function, which states that as the real GDP of an economy rises, or the income, the demand for money will also increase to support this increasing economic activity. And that's exactly what my empirical research is based on. I have taken a daily time series of this crypto GDP data I have collected from 2014 until 2022. And I have regressed it against the growth of stablecoins and did a co-integration test and can confirm there's indeed a relationship between these two variables. And the results show that as the crypto GDP increases by 1%, the demand for money within this economy increases by twice as much. This means that as the crypto economy continues to grow, the demand for money will also grow, leading money to flow out of fractional reserve banks into full reserve banks. And this problem is unaddressed by the digital euro, simply because it does not satisfy the demand for money being created by the crypto economy. Why? Because the digital euro does have borders and is not accessible for everyone with an internet. It's not accessible for everyone. For example, someone in Asia can open a wallet, receive their stablecoin, and just send it to their friend in South America. You could just say, open a wallet and send me your address, and they could just send it without any hurdles. Now that we have had all of this, I would like to make a couple of predictions. And the first one is, now that the United States has put their weight behind stablecoins, I think in a very short period of time, stablecoins will grow to at least $1 trillion worth of stablecoins outstanding. Which leads to my second prediction, is that regulators will finally recognize as a serious financial stability risk and consider evolving stablecoins into some form of synthetic CBDC or wholesale CBDC. And a synthetic CBDC is basically the stablecoin technology wrapped around central bank reserves. And my third prediction is, I believe perhaps that the digital euro legislation could serve as the backbone for using synthetic CBDCs as a payment method or legal tender in Europe and in the crypto economy. Now that we had all of this, I put you to think, and I would like to brainstorm together. I have a couple of questions for you. And the first one is, would there be demand for the digital euro if it is not compatible with crypto? Please raise your hands. Yeah. For the digital euro. Why?
Spaces for people that aren't in the crypto space still exist. And I guess digital euro can unlock some value which bank deposits cannot at this stage.
What kind of value?
Cross-border transactions in the European Union itself, for example, we have banning on the outside, instant payments, and more secure.
And one more. When you break staking on DeFi, when you place your funds for yielding.
So for?
Yielding. I need to earn the yield.
Yeah.
Very short term.
Mm-hmm.
And many guys from DeFi sector that are coming to our traditional sector for the yield. And it's very popular now for platforms which are giving DeFi sector an opportunity for the yield coming from traditional financial institutions.
Yeah.
You know, US treasuries, we know scientific this, So, I think that the most protective approach is to use the opportunity with the opportunities from the broad DeFi and
yeah.
Build the this
exactly.
And too many guys from DeFi, I'm doing both. I have more than 37 years. I'm doing both. I think you shouldn't be, let's say, negative to the rest of the. I mean, DeFi again, DeFi traditional finance. We must work together.
Yeah, I agree.
Yeah, this is the point. Actually, the touching point is reward taxes.
Yeah.
This is a touching. And
yeah, it's still very much figuring out how these two worlds are going to come together, and in the real world and regulations, and if they even can really work together. It's still a space to explore. And that's exactly what I want to achieve with my thesis, like finding where the nuances are and how we can.
I mean, agnostic approach goes. Agnostic means that if there are not evidences to use this particular financial instrument, go there. Don't say about it.
So the second question, at least, did anybody else have something to add? Mm-hmm. Yeah. And which use cases are you thinking of? Mhm. Yeah. Mhm. Yeah, because for example, at the Dutch Payments Association, we are subsidized by the banks, so ING, ABN, and Rabo. And we always argued, at least at the Dutch Payments Association, we said, why do we need a digital euro? We don't need it. We have EPI. Why would people even go to the digital euro if we have Visa and MasterCard while it already works? We were already wondering, can we even get EPI going? So I always thought from a perspective that the digital euro has to offer something new. And yeah, so also the, for example, the monetary sovereignty and the fragmentation of the payments market, yeah, those can be solved with EPI, for example. Anyway, yeah. With regards to, yeah. So Luna, I'm not a proponent of Luna. Yeah, of algorithmic stablecoins. So the ones I am a proponent of is, well, at least I am not really a proponent of full reserve banking even. I am more a proponent of accessible for everyone and no borders. Yeah, I know you have this risk with regard to illicit financing, but this risk also exists with with regular dollars, and this freedom of being able to send money is what has allowed real innovation to happen. Real innovation to happen.
But this is not a stable coin. It's a freedom coin. It's stable. You should hold reserve, which is absolutely direct. Otherwise, how are we going to protect the customer?
Yeah, so with regard to so fiat stablecoins in the case of Tether or Circle, yeah, USDC. So Tether doesn't, well, at least nobody really believes their audits. Well, they have proved that they can redeem. They can do redemptions. They have proved it by redeeming at least, I think, 10 or 15 billion during the Luna crash. So they have proved themselves, which I think is actually the most important factor, because Circle does have audits. We believe it, but they defect. So, and Luna, I'm not a proponent of it at all. Like, I don't believe in algorithmic stablecoins. I just want to see a free money, because Bitcoin is, before 2017, everybody said, yeah, Bitcoin, that's going to be the money of the future. But Bitcoin is not a store. Well, yeah, it's not money. Money is unit of account, which you can exchange with, and a store of value. Stablecoins do look the most familiar to money, but it's not actually money, according to a Bank of International Settlements. But anyway, let's go on to the second question, which is, can a digital euro exist that functions exactly the same as stablecoins? So accessible for everyone and no borders. Do you believe that can exist?
Yes.
Why?
Especially for retail. It's possible. And it will happen.
Mm-hmm.
Because you could open your digital wallet everywhere without any permission.
Exactly.
That's why.
So, but can a digital euro backed by the ECB, can that also exist? Like with free and accessible for everyone and able to use in crypto as well, like in decentralized finance applications. Can that exist?
It's going to be a different protocol. So again, we're looking for a bridge between digital euro, but we're fine. I don't think.
Does somebody else also have an opinion on this? Yeah. Well, it does pose risk to financial stability. Yeah. Yeah, the dollar already has it, but we do want to protect our own. We want to protect Europe. So anyway, anybody else on this question? Yeah, exactly. I completely agree. Because if there's a decentralized finance application which is built by some genius coder somewhere around the world, and I want to send my money there, like 10,000 euros, I won't be able to do it, which doesn't make sense.
Can you imagine what's going to happen with the balance sheet of the commercial banks? Can you imagine how volatile it's going to be the one?
Willem actually showed it. He was showing what was the you were showing like 40 billion or 50 billion like stable coins. Right now there are $200 billion of stable coins outstanding. That means directly $1 for every stable coin that's outstanding is being backed, allegedly. Yeah, and it's going to $1 trillion, I predict, now that the United States is backing.
Commercial banks, which is Europe, they don't support each euro in general.
Yeah. We were against it.
Their biggest support. Real business.
Yeah.
Like coal industry in Germany also needs a transition plan to stop same you need for the banking industry because there are a lot of people working there against it.
Yeah.
You need a transition plan. But 3,000 limits makes no sense. You can forget it.
Well,
you
we
need the transition plan.
And the digital euro legislation actually does force banks to think about this. What I have noticed, because we as banks, we were completely against it. But the European Commission pushes through with the legislation. So we were forced to have a positive look at the digital euro. So I think that's a good thing about the digital euro legislation. Yeah.
I think that with the ruling limits, it will come down to what will be remuneration per transaction for the commercial banks
Because if the payment side of the digital euro will be more efficient than the current payment factories of banks, there will also be a strong incentive for banks to adopt this. And then even it can be useful with all of it. It should be if the remuneration per transaction will be the whole system will be more efficient, then there will be also incentive for banks to payment side.
Yeah. Yeah, I believe with the commercial bank money token, it's you have this KYC boundary, and you can't go outside of it. And what I think will happen is you have this unregulated industry, which decentralized finance, that will continue to grow, but you will also have banks adopting blockchain technology and using this commercial bank money token, which they will probably use to facilitate with wholesale CBDCs and settle tokenized securities transactions. So you'll have this regulated blockchain industry and unregulated industry. But I believe the real innovation is happening outside in the unregulated area. And that's actually where you should be focusing. And yeah, I still think it's good that banks think about how can we apply this technology in a compliant way. Yeah.
Zero knowledge protocol.
Yeah. Okay, and for my last question is, could synthetic CBDCs be considered as legal tender under the digital euro legislation? So could it be used as payments as legal tender in the point of sale and also in the crypto industry? Mm-hmm. Yeah. Yeah, because ideally, I would love to be able to use this cash for both DeFi, but also to pay at the supermarket, and all I see is just €1, not Circle euro or Tether euro. I don't care. I just want a euro which I can use everywhere. Does anybody else have an opinion on this? So it's very simply said, it's a stablecoin wrapped around central bank reserves. So it's risk-free money, risk-free stablecoins. Right now, stablecoins are pegged to a euro because I give you a coin, I say it's €1, and everybody here believes it's €1 because you trust that if you give that euro to me, I'll give it back to you. But with the synthetic CBDC, it would be backed by central bank reserves, which is actual money. So it's guaranteed to be risk-free. So to answer my first question is, can we rebuild trust in the financial system? I am not so sure, because the boom and bust cycles which lead to inequality continue to persist within the crypto economy. But I do believe that this technology can create more inclusiveness, more transparency, and lead to a fairer society for everyone. I hope I left you with more questions than answers. Thank you very much for your attention. And yeah, thank you.
Great, thank you, Abdurrahman. Very engaging discussion. And our third presenter now is Michael Dours. He delves into the legal backbone of the digital euro. His thesis is entitled Evaluating or Analyzing 3 Key Legal Issues of the Single Currency Package. Of course, a very important aspect of the digital euro coming to fruition. He delves into the legal backbone of the digital euro, like I said, focusing on legal tender status and the right to cash and data privacy. And he also evaluates the legislative proposal from the European Commission and the ECB through the lens of constitutional law, policy goals, and democratic accountability. So let's all give Michael a warm welcome to the stage.
All right, thank you for inviting me today. So we're going to delve firstly into the methodology. I let myself be inspired by Lord of the Rings for the subtitles. So the Fellowship of the Digital Euro, where everybody fights over competence. The 2 towers of the right to cash with 2 really important parts, acceptance and access. And of course, always the return of the privacy king since GDPR. So for my methodology, I analyzed the general policy goals of the ECB and the Commission and the specific policy goals for the digital euro and the single currency package. And these were the 5 we determined. So complement cash, not replace it. Ensure financial stability, which Willem already discussed. Existing legal frameworks must be respected. The importance of privacy, and of course, the universal availability, financial inclusion, as Abdurrahman had an interesting discussion about. And I held it against 3 legal issues we identified through doctrine. So the competence to adopt legal tender, the codification of the right to cash, and CBDCs versus privacy. So in the Fellowship of the Digital Euro, we look at Article 128, which I mentioned before, and Article 133, which gives the Commission competence to adopt bills or regulation about the currency as a whole, and Article 128, which gives the ECB the competence to publish legal tender and to issue legal tender. But of course, CBDC is a novel legal tender, and it's the first adoption of legal tender we had since the introduction of the Maastricht Treaty. And of course, there could be a teleological interpretation of the TFEU that banknotes could be associated as that CBDC is just an extension of banknotes. But of course, it feels very difficult to defend it. And then also the digital euro is being used as an economic and monetary policy instrument. It's mentioned in the proposal, and the ECB doesn't have competence on that point, rather the Commission has. And then we have the discussion about banknotes versus currency. Banknotes are mentioned in Article 128, but Article 133 mentions currency, and it's actually stronger to align CBDC with currency rather than with the notion of banknotes, of course. Could there be a treaty amendment? In theory, yes. In practice, probably not. I think it's very difficult for such a small change to have the necessary backing by each European country, especially as there will be a lot of rent seeking and a lot of other actors trying to push through other amendments in not so relevant aspects for digital euro. And of course, the fragile balance of competence they have created for themselves. They have the legislative competence lies with the Commission and in extension the Parliament and the Council. However, architectural decisions and the holding limits, which is a very important part, as we have discussed already today, are located with ECB. However, the holding limit is a very contentious aspect because it's also a kind of an economic and a monetary policy decision. And it's very unclear, and it's not actually regulated or controlled by the Parliament, which is the most important democratic actor in the current state of the EU. The architectural decisions are also important, and currently these 2 processes of legislation and architecture run parallel, but as we will see, with regards to privacy, it's very difficult to regulate something when you don't even have an idea about the architecture. Moving on to the right to cash, for me personally, a highlight of the single currency package. We have the two towers, as I discussed, acceptance and access. Acceptance is something that was already kind of recognized within the EU through legislation and also through courts, through the European Court of Justice. So it was more of a codification effort and codifying in a regulation the current acceptance regime within the EU, which differs per country still. However, the countries still retain certain broad powers with regards to the acceptance and both the access. However, the access, as the Commission identified, is necessary for the acceptance. If you don't have anywhere to get your cash, it will be very difficult to then use it in any shop you want. Then finally, the return of the privacy king. Of course, since the GDPR, a very big topic, I think every company regularly has problems with GDPR or compliance issues with GDPR. It's a very broad regulation, and it also has an impact here, of course. However, they try to address it in Chapter 8 of the Digital Euro proposal. So they recognize the principle of privacy, and that has to be recognized in infrastructural decisions. And they try to address it through the online and offline digital euro. However, as through doctrine, it became clear that it was actually a missed opportunity, as the EDPB, the European Data Protection Board, recognized that CBDC may offer opportunities with regards to privacy, but that these were not recognized by the current proposal. So we have the role of payment service providers and the role of the euro system. We will have to monitor the holding limits, and we will have very broad access to basically look at everyone's accounts. I oversimplify a little bit, but that's what this comes down to in practice. However, as we mentioned, there is still a lot of technological uncertainty, and some of these issues may be addressed through the architecture of the digital euro. Then we have the role of providers of support services, which is still very unclear, and also it seems like they forgot to write dispute resolution into Annex 5 with regards to the data access they will have, but we'll see in future proposal how they will address it. Then a few selected issues, the AML CFT framework. So I think for the online digital euro, it stays kind of the same. The offline digital euro, they say they will not look at transaction data, or they will look at transaction data, but then at that point, I don't really know what the difference would be with the current AML and CFT framework. Then there is a labyrinth of competences. The ECB will have to monitor their own privacy with a little bit of support from the European Data Protection Supervisor, as will the Commission. In my personal opinion, I don't think the Commission has a very good track record with regard to privacy, so maybe an overarching supervision mechanism could be interesting here. And then, of course, the principle of data minimization versus innovation. In the digital euro, they aim to address disintermediation through holding limits and through the extra services they may create. However, auxiliary services, they will have a very negative effect on data minimization, and I think it will be difficult to reconcile it with the general GDPR regime, as you will look at probably, for a lot of people, very sensitive data, their payment accounts. And I think it misses the point with regards to privacy. To conclude, to look back at the single currency package, I think it's a mixed bag. I think it's very strong with regards to the right to cash. I think it's very important that the use case of cash is well defined. However, I don't think the use case of the digital euro is as defined right now between digital bank money or commercial bank money and cash itself, as cash itself offers a lot of privacy options, which this digital euro currently misses the mark on. Then with regards to financial stability, I think there are very broad protection mechanisms. In my opinion, a little bit too broad. I am not as well educated with the financial aspects as Willem and Abdurrahman, but in my opinion, the question shouldn't be, can everybody transfer their money to the digital euro, will they transfer it? I think the option of that was established in Article 16, that there can be no interest or no yield as in stable coins on the digital euro. I think that's the protection mechanism for banks. I think they should ensure that they have the necessary deposits through adopting interesting interest payments with regards to savings accounts. I think the digital euro is more of a checking account rather than a saving account for most people. So I think it will only be a proportion of deposits that will be lost. Even in that case, I don't think holding limits are necessary for the digital euro. And if they are necessary, maybe in a tiered system, as one of the audience members mentioned, that it should be a process and not a one-day change. Then the existing legal frameworks, as I mentioned, I don't think it's in line with the current treaty, but I don't think it will be necessarily addressed. And it was a codification effort with regards to the right to cash. Then finally, privacy is essential. However, currently it misses the mark. And architectural choices will be essential. And I think that's also the point I'm making with regards to universal availability, financial inclusion, and ease of use. The architecture will be more important. We have a lot of opportunities there, and I think the ECB should take these opportunities and seize them completely. So thank you for listening, and also congratulations to the other two Thesis Awards laureates.
Thank you, Michael. That was quite engaging and also quite informative. Of course, the legal package, quite an essential part of delivering a successful digital euro. And now perhaps the time we've all been waiting for to announce the order of the finalists. Each finalist will receive a certificate, but also a cash prize, as stated in the Thesis Awards communication. And in third place, and from the University of KU Leuven, we have Michael Dours. Thank you. Congratulations, Michael.
Thank you.
All right. And now, in second place, from the University of Utrecht, we have Abdurrahman. And of course, then, in first place, from the University of Twente, we have Willem Vicent. Congratulations.
Thanks a lot.
No problem. Congratulations. Great. So to all of our finalists, thank you very much for your inspiring work. Your work is well recognized and doesn't go unnoticed. And we are certain that it will make inroads towards, the future of digital money. So congratulations to you all again. We have a few minutes before lunch, but that's your free time to go and explore the rest of the program. But otherwise, just one more round of applause for our finalists.
I need to speak here, maybe. Hi, everyone. My name is Celine, and I'm the moderator of the Innovation Room. If you have any questions that you want me to ask during the Q&A, just let me know. And I will start with a brief introduction to our first speaker. It is Javier Garcia, and he is the global lead of digital assets. So I will welcome you to the stage.
Thank you very much. Oops, quite high. So good to see that at least we have some people after lunch. That's a really good thing to see. So first of all, as an introduction, as I said, I'm leading digital assets at Kaleido. That's the company that I represent. Kaleido is an enterprise blockchain company that offers a wide range of services and products to our clients, going directly from chain infrastructure as well as Web3 middleware in a digital assets and tokenization stack. But today, what we're going to be showing is just a particular product that we open sourced in November last year. We did so in Singapore FinTech Festival, which is called Paladin. It's a product that resolves privacy in the EVM space, and we did the open sourcing through the previously called Hyperledger Foundation. Now it's called Linux Foundation Decentralized Trust. So what you're going to be seeing today is two examples that I'm probably going to be spending 7 or 8 minutes and giving some time for questions, where we have been using Paladin in real production use cases or with real clients, even with banks and financial institutions. The first one of it is the Guardian Wholesale Network. So a little bit of a background. The Guardian Wholesale Network is a multi-member and multi-asset and multi-currency network that was created under the Guardian framework in Singapore that is regulated under MAS, the Monetary Authority of Singapore. And it was created with one main purpose, right? Initially, there were three main pillars around use cases. One was around FX, foreign exchange, another one around asset and wealth management, and another one around fixed income. And all of these use cases were being done in separate networks, separate infrastructures, right? So last year, MAUS decided that it really made sense to have a common infrastructure for all of them. As you can see here, Guardian is a very big project there in Singapore that amounts for a lot of members, policymakers, regulators, and even financial institutions. And the main purpose that GWN, and those are the initials of the network, was to create a test net that could deliver cross-use case composability, right? We really wanted to make sure that there was a shared infrastructure to start using all those assets across the different industry pillars, right? And as you're going to be seeing today, one of the main purposes from this network was, aside from showing composability, we wanted to make sure that we could have delivery versus payment, we could have payment versus payment transactions in a composable way. And every time we say composable way, sometimes we call it also the institutional DeFi way, because if you're more used to how DeFi works, where I can take an asset, I can just collateralize that asset, I can just lend something. We wanted to do a similar thing with traditional assets that banks are used to have in their balance sheets. So just a couple of the unique features of the Guardian Wholesale Network. As I said before, it was a multi-asset support. It's very cost efficient because it was just providing one single infrastructure for all of them. Given that composability that I was referring to before, it was open and interoperable for all the members. And each of them had their own specific configurations. And this is very important because that means that every member in the network had their own node. So having a node in the network, it's quite important for just making sure that you can send transactions and receive events, but it also has some drawbacks. And the main drawback is that you can see everything that is happening on the network, right? Blockchains, as default, they are transparent. So you can see what your competitors may be doing, right? So one of the key things we wanted to have here is how can we enable privacy? How can we make sure that if two financial institutions decide to trade a bond, that bond is only visible for them, and the other members of the network that have nodes cannot see what they're doing. They cannot see the amount they're paying for transactions, right? So this is the architecture that we had for the Guardian Wholesale Network. As you see, it was a network 4 or 5 members. We had a combination of banks and asset managers. HSBC, Standard Chartered, Citi were involved, Schroders, UOB. So we had a big combination of financial institutions and asset managers, and as well as MAS as a regulator who was an observer in the network. And all of them had the same middleware stack and the same connection to that network. You will see there as well, there's some minor icon. Some of you may recognize that thing at the bottom, which is the B from Hyperledger Besu. So this was a private permission network that was created there just as a test net and to make sure that everyone had the ability to test freely what they wanted to test. And the main reason why we also did so is because us, as Kaleido, we are the enterprise maintainers of Hyperledger Besu. And we could just give them all the support in the network. So just giving you more and more details of what we tested. As I said before, all of the banks were using the same application at the top. That means they all had a common application that was equal for all of them. They all had the same front end, let's put it that way. And they had access to many different products, right? We had products around fixed income, and you see there bonds, repos, right? Things that really make sense. It's not just issuing a fixed income product. When I have a fixed income product, I can do more, right? I can collateralize that. I can do repos with them. We had the same thing for tokenized cash and FX. And on the asset and wealth management side, we had bonds. We had funds. And all those products had different roles. So you see there are a lot of roles, and indeed we had 15 roles in that network. Each of them were just participating according to what they wanted to be in each of the single transaction. That's where composability really makes sense, right? Sometimes you may become a custodian, on other times you may be an issuer, right? So they really wanted to test how that multi-party network and multi-workflow works. And then at the bottom, you see that we had that wealth-free middleware, and Paladin as the privacy ledger was incorporated in the network. Just to give you like very, very high level details of all the different sections that we had on the tokenized cash and the FX side, we tested a bunch of stuff. Obviously, the most interesting one is not the issuance of tokenized cash, because that has been tested many, many times, but it was more around how can we use different forms of cash for FX, right? How can we start having FX trades within that single network? If we move on into the funds side, we had a similar use case where we issued a tokenized money market fund, right? And we started to demonstrate how that life cycle of the product could be managed throughout all the roles that we had before, right? How could we distribute the money? How could we pay dividends on that money market fund? How could we have a secondary market on that money market fund? How could we redeem that money market fund? And finally, and just going more into the details of the privacy section, we did the privacy component really focus on the fixed income side. How could we have private zero coupon bonds? Private meaning they're just visible to the individuals in that particular transaction. And also that means that the money that was being paid for those bonds was also private, right? And after that, there was also a section around repos, repurchase agreements. How could we enable intraday per minute repo rate transactions in that single network? So just giving you a very high level explanation of how Paladin was implemented. As you see here, I could spend a lot of time explaining everything that you see on this slide, but at a very high level, what you see on the left-hand side is how, traditionally speaking, in the EVM world, bonds are structured. There's a bunch of small contracts that are created with an architecture that manages everything on the bond side: issuance, distribution, how you maintain the registry of the investors, everything, right? But there's a key issue there. And the issue is that everything is publicly available for everyone. So anyone that has access to the blockchain, that has a node, that can see the block explorer, they can see all transactions. They can see everything. So with Paladin, what we did here is just implement all the different privacy ledgers to make sure that we could have what we call need-to-know basis on that transaction, right? If I am an issuer or I am the custodian, I have access to specific data of that bond, right? I can know who the investors are. I can know their wallets are linked to a specific individual. I have that connection between a real person and a wallet address. That's a really important thing. But just for the issuer and the custodian, because anyone else in the network, they don't need to know that information, right? And on the other side, you see investors, right, with subscription data. if I am paying X amount of US dollars or Singapore dollars in this case to buy a bond, that's my private transaction. I don't want anyone else to see what I'm paying or what amount of the bond I have, right? So that was even private to the bond custodian or the investors. So I'm just giving you some screenshots, and probably there's going to be a video later that explains this a little bit more. But it was very simple in that common application for everyone to just go create those bonds. They had templates already created that was simplifying all the process of deploying a smart contract. Everyone that we're working here in blockchain, we understand that just creating a product is not that simple. You need to create a smart contract, you need to deploy the smart contract, you need to wire everything. So we had really simple templates for them to understand whether they wanted to have a traditional bond that is publicly available for everyone or a private one. And also on the cash token, right? You see that C, meaning that it was a private tokenized deposit there as well, meaning it was only visible to the individuals that hold that token. From a visibility perspective, I was referring to having access to the node. I was referring to having access to the block explorer. So what you can see here is that with Paladin, I could also spend a lot of time explaining how Paladin works, but in reality, the tokens that we're using are using a UTXO model. They're just using states. So if you look into a public block explorer, the block explorer that was available in the network, what you see on the left-hand side, it was what everyone could see, right? It's just some inputs that were being spent and some outputs that were being created. Nothing else. There's hashes. No one understands what it is. But if you look with the lens of Paladin, if you are someone participating in that transaction, you get more details, right? You understand about the amount. You know who's the from address, you know who bought, you know who sell, right? Because you are part of that transaction and you really need to understand that information. So that's everything, very high level. I wanted to rush just to give some questions at the end. So that's what happened on the GWM project. And another one where we participated was on the UK Ireland hackathon, in which where we won the hackathon. It was also demonstrating how Paladin could be used to create a private permission network or public permissionless networks that use Paladin to protect some data and interconnect that network with the Ireland UK infrastructure. So giving you very, very high level overview of how the Ireland infrastructure is created is that what you see there on the left-hand side in gray is the infrastructure that has already been created in the UK Ireland. There's an API on top that gives access to everyone, all the participating banks and all the participating commerces to get access to money, right? That's the UK regulated liability network doing. They get access to either tokenized deposits. There's also access to central bank digital currency. There's also some testing around connecting this to open banking. But in this particular use case, we wanted to give access to the tokenized deposits, right? But everything that happens on UK Ireland is linked to money. It's just cash because they want to maintain singleness of money on the cash leg. So what we did was what you see there on the right-hand side, right? On the right-hand side was we created another hyperlayer-based network just for the sake of the hackathon. It was really quick and we had to make this in one day. And in that network, what we did was we just created a tokenized bond. We used the same technology. We used Paladin. And what we demonstrated in this hackathon was how can I use privacy on the bond on an EVM chain, right? And connect that in a multi-network bridge to that Ireland API. So in reality, what was happening here is that using the privacy that is already embedded in the Ireland API, no one knows what's happening there because it's a ring-fence infrastructure. On the other side, we demonstrated that we could use Paladin with any EVM network to also apply privacy on the asset side. So in this case, it was a bond, could be applied to a fund, to any tokenized security. And here I have a quick video that I'll probably be jumping around. So I really want to give you an overview of what was the experience for everyone. I think it's here. It is here. Yep. Okay, so this is the common UI that all the participants had in this kind of like infrastructure. You see here that for this particular There you go. Yep. Yeah, so that's the access that you see where everyone have the ability to see the bonds. As you see, we're just going through the process of how to create a bond. It was a simple thing, as I said before. We had already created all those templates for everyone. You see that those bonds are confidential in a sense, but in reality, we already had created that for everyone. It was a really quick one to show how everyone could get access to it. In this particular use case, what we were just showing to the participants of the hackathon was, this is the RLN API network, where we were just seeing all the different balances that were being involved, because in reality, we needed to test interop, right? And testing interop is not saying, hey, I'm just clicking 3 transactions and everything is working, right? We really needed to test that. So we were showing the different transactions, and in this particular use case, we created a dashboard of how an investor, and we had different names there, could just participate in a bond secondary market, right? How in this use case, they could use that zero knowledge bond that you see, that set bond, and they could use many different payment assets. We could have used a confidential payment token in that hyperlayer-based network. But in this case, we wanted to test that interop. So we chose an RLN payment asset. And after that, it was so simple as with every single transaction, you just, what is the amount that you want to pay, that you want to buy from the bond, who's going to be your executor, and all the transaction should be going through. But one of the most interesting things about this transaction is that from the RLN perspective, and I'm going to be pausing here just because there's just some steps that are just particular to the transaction, and I'll just hop over to Paladin, is that if you're doing an iteration between 2 different networks, you need to really use some sort of like escrow or HLTC contracts, right? So in this particular transaction, we really need to make sure that once the payment happens on the RLN, I can just release the securities on the EBM side with the bonds. But the most important thing, and I'm going to be just going very quick, and sorry to jump this, is to really demonstrate what was available on the what was available in Paladin and what everyone could see within the explorers. And so what you can see here, that is the Paladin explorer that I was referring to. So as a participant on a transaction, I can get access to the private data that I have. I can go to those receipts and I can see all the amounts. You see that the amounts that are over there. You see the owner of the asset. You can see who you're selling to the asset. So that is something that you have access to because you participated in the transaction. Anyone that was trying to connect to the network and using the public explorer, they couldn't see anything. But it's even more important because if you have also Paladin, you're part of the transaction and you're trying to see what someone else did, you couldn't even see it. So it's not that because I have Paladin in the network, I can see everything. It's because I have Paladin and I'm part of that transaction, right? I have a need to know responsibility into this transaction, right? So you see, and I'll pause there again. You see, this is someone that was not part of the transaction, right? If they want to see what happened here, they just see some states. They just see some states that were confirmed, some states that were spent, right? It's completely private to the individuals in that transaction. I don't really want to just finalize this because at the end it's just showing the technicalities of how this worked. I think you really understood what was the benefit of using Paladin within the single transaction. If anyone is interested in looking at the full video, the UK finance team who organized the hackathon, they have everything public available. You can see the full video and the presentation over there. But I just have two minutes. I really wanted to give the floor to anyone who has some questions here. Yeah, go for it. This question.
Thank you for the presentation. Yeah, privacy is really important for the next gen application in blockchain. So in a way that we can comply with the policymakers. But I have a question about how do you manage the user data? So for an investor, when he connects to your portal, how do you manage user data?
That's a very important question because every time we talk about privacy, we end up just discussing whether we should be using one technology over the other at the smart contract level. We see a lot of conversations whether we should be using zero knowledge proofs, whether we should be using fully homomorphic encryption, but that's just the on-chain information. What we've seen is that traditionally speaking, in 95% or 90% of the use cases, when you really want privacy on the workflow. You want privacy with the off-chain data. So Paladin as a solution is a solution that covers the end-to-end, right? It's not just giving you a set of small contracts to protect privacy on-chain. It's also giving you a wallet to just understand how to, for example, create zero-knowledge proofs. It's giving you a transaction manager to send all that information to the chain, as well as an indexer to receive the information and really index the information that you really need to take care of. And talking about the user data, it is also coming with private databases that allow you to just store that private data for yourself, as well as, which is very important, and that's why I was referring to the workflows. There are a lot of workflows that happen between participants, and you need to send data to other participants through secure transport layers, right? MTLS, something like that, right? So all of that comes with Paladin and gives you off the shelf an infrastructure to manage the private data either on-chain as well as off-chain.
Thank you.
Good. I see that the time is already red, so I'm going to be closing this up. Just want to say that if anyone else is interested, we're happy here to discuss. As I said before, this is an open source project. Everyone can just go to the Linux Foundation Decentralized Trust, see the GitHub repo, and if they have any sort of questions, just feel free to ask. Thank you very much.
Okay. So our next speaker will be the manager from the Central Bank of Korea. Let's give a warm applause to Hyung Koo Lee. Thank you for joining us.
So, hi everyone. Sorry. Yeah. My name is Hyung Koo Lee and I'm from the Bank of Korea. So I'm very happy to give up my presentation, to have an opportunity to give up my presentation about the Bank of Korea's CBDC research today. So I would like to share the Bank of Korea's CBDC research. My presentation today mainly consists of two parts. First, I'm going to provide kind of overview of what we have done, and in the next part should be our digital currency pilot test that we are now doing, and also we are going to real world transaction test from the during the second quarter of this year. I mean from the April 1st. So for the second part, I'm going to I will kind of in detail to talk about our digital currency pilot test, including the key features of the project and the system design, the digital currencies that will be issued, and lastly, the scope of the project. Let me move on to our the Bank of Korea CBDC research. So at first, the Bank of Korea had focused on the retail CBDC. Between 2017 and 2019, we conducted a series of tests to check whether the DLT can be applied to the payment and settlement systems. Also, we formed a kind of task force to publish a paper that covered about the general and overall issues about the retail CBDC. In 2020, we have established a dedicated CBDC research unit, and since then we ramped up research into CBDCs. Of course, with a primary focus on retail CBDC. Our CBDC simulation project was carried out in two phases. The first phase was in 2021, and the second phase was 2022. Following this simulation project, we, the Bank of Korea, carried out an extended project in collaboration with 14 commercial banks in Korea. Beyond this technical research, we also have done we also have conducted in-depth research on legal and institutional issues regarding the CBDC. Also, we also analyzed and published some academic papers about CBDC's potential impact on our financial systems. So let me explain the outcome of our simulation project. Initially in 2021, we implemented the entire stages of the retail CBDC lifecycle, including issuance, circulation, and redemption. We developed a system, of course, based on the DLT. The figure in the left shows our mock-up configurations of mock-up digital wallet we developed. For user convenience, we designed our mobile wallet quite similar to the user banking app that many people are using these days. Building on this, in 2022, we expanded our testing to check the technical feasibility of advanced features, such as conducting transactions offline in environments lacking internet or network connections. The figure in the right shows our offline CBDC payment process. We assume the situation of an internet connection outage on both sides, a sender and a recipient. In this case, we can continue our transaction by NFC or Bluetooth functions of our devices, such as mobile phones or IC cards. For this project, we signed kind of MOU with Samsung Electronics, which is a Korean company. This simulation test confirmed that both the basic and advanced functionalities performed as anticipated. However, they also highlight further areas for enhancement, such as data privacy protections. So let me move on to our future direction for CBDC research. And based on our experience and lessons from previous research, we have decided to expand our research scope toward the wholesale CBDCs. That is, we will focus on wholesale CBDC research as well as we will conduct advanced research on retail CBDCs. As part of our wholesale CBDC research projects, we have been preparing the pilot project, and I will explain in detail, but the main purpose of our pilot project is to explore a future monetary system. So this project is based on the unified ledger concept proposed by BIS. And we are going to explore potential use cases for digital currencies, which will be tokenized deposit that will be issued by our commercial banks. In addition to our wholesale CBDC research, we are going to keep going our retail CBDC projects, such as to focus on the advanced technology research, including offline CBDC payments and data privacy protections. Let me move on to our second part, which will be explanation about our digital currency pilot project. So this is the logo for our project. We have named our project as the digital currency test project Hangang. Hangang means the river of Korea, which flows across the Korean peninsula. We named our project as the project Hangang because we thought that the currency and payments serve as kind of economic lifeline, which much like the river the Han River, which flows our Korean peninsula. So our project aims first to lay a foundation for innovative payment and services. Second, to explore efficient solutions for processing transactions on emerging financial products, such as token securities. This project is a joint work between the Bank of Korea and Korean financial authorities in cooperation with the BIS. We have collaborated with the BIS to design our architecture and have jointly published a paper. In that paper, we propose a model for future monetary system where commercial banks will issue their tokenized deposits and wholesale CBDC will be utilized for interbank settlement. So as you can see, there are, this is the figure in the left shows our CBDC network architecture. And there is one CBDC system and one connected outside system. Of course, there can be multiple outside systems, but for the sake of simplicity, only one outside system is presenting the figures. And wholesale CBDC issued by the Bank of Korea, of course, will act like kind of reserve, and only financial institutions can hold the CBDCs. Here, DC1, we named DC1 as the we name tokenized deposits as DC1 here. And DC1 issuance will be only limited to commercial banks as it is designed to follow the features of current deposits. Here, DC2, which will be the tokenized e-money, is intended to accommodate non-bank participation. Considering the difference between banks and non-banks, such as the regulation intensity, a DC2 issuer who will be mostly a non-bank is required to hold an equal amount of CBDCs corresponding to the value of digital currencies they issue. DC3 can be issued on the connected outside system that would be actively emerging in the future. However, it must be linked to the CBDC system through the DC2. That means to issue DC3, the issuer should lock the same amount of DC2 in the CBDC system. So in the case of DC1, liabilities are not transferred between the banks in the same manner as with the commercial bank deposits. So this DC1 will follow the burn-in-issue process. As I told earlier, the foundational concept about our pilot project aligns closely with the unified ledger concept proposed by the BIS. We believe that the project should investigate the potential benefits and challenges of embedding programmable features into digital currency. The functionality is expected to enable real-time immediate settlement of complex transactions and atomic settlements across assets. In addition to our domestic project, on the international level, we are collaborating in Project Agora along with the BIS, the IIF, and the 7 other major central banks. So I would like to briefly introduce our timeline. In 2023, we conducted an in-depth review of legal and institutional issues through close discussions with relevant stakeholders. And during 2024, we developed and built the necessary systems and conducted the proof of concepts. Finally, in the second quarter of this year, we are going to invite up to 100,000 general users to participate in our project, to enabling them to use the tokenized deposit in real-world transactions. So our POC tests are based on the idea that CBDCs and digital currencies could support the digital transformation of the economy. So we believe that to ensure the stable and sustainable development of the digital token economy, tokenized payment instruments need to be introduced as well. By doing so, we believe that the DBP process can be proceeded accordingly, and we will reduce the kind of settlement risk related with the digital assets. So these 3 experiments were conducted in virtual environments, including the DBP of digital assets on the connected outside systems. Also, we carried out the digital asset IPO test. Also, we issued kind of the securities on our CBDC system to track the DBP in our system. So I will introduce our real-world experiments with the digital currency. So general users will be invited to participate in our experiments. And users will be able to open their digital wallets through the participating bank's mobile app. Once issued, the wallet will allow users to convert their current deposit, to tokenized deposit, and to vice versa. For usability of our tokenized deposits, people will be able to use for their tokenized deposits for purchases at designated stores. Payments will be made via QR codes, and unlike traditional payment services, merchants will be able to receive funds instantly without any transaction fees. This feature is expected to benefit both beneficiaries, both businesses and consumers by providing a more efficient payment methods. In addition to enable the public to directly experience the utility of digital currency, our real-world transaction test is intended to improve the world. This is based on the idea that CBDCs and digital currencies can contribute to promoting innovation to improve current financial services through its programmable functionalities. So our project will be carried out in collaboration with local governments, including Seoul City. We aim to integrate its voucher programs to test the real-world applicability. Currently, we believe that government subsidy systems face several challenges, including high fees and complex settlement processes. However, we believe that digital currency can help address these problems by utilizing its programmability. For example, we can set specific payment conditions, such as eligible locations, items, and expiration dates. Payments will be automated, reducing fees and simplifying settlements. Also, verification process can be automated. As a result, false claims can be significantly reduced. Lastly, we are going to, if our test shows the successful results, then we will be able to build a new public voucher system based on our digital currencies. It will mean that it will eliminate any kind of system duplications and fragmentation, leading to greater overall efficiency. Also, lastly, traditionally, voucher users had to carry their paper vouchers or physical cards, but in this test, they don't have to do that. What they only have to do is to bring their mobile phones. Lastly, to make our real-world test possible, we try to implement necessary legal and regulatory measures. For example, to establish a clear legal basis, we went through the application of financial sandbox regimes. In addition, to ensure the legitimacy of contracts between issuers and digital currency holders, we make the commercial banks to synchronize the related data in the CBDC system and their own ledgers. Thank you for listening my presentation. Thank you. So any questions? Yeah.
Well, if there's no more questions, then I will just say thank you, Mr. Lee, for this presentation. And then next up, we will have John Velisarios, and he is the founder and director at Otranto Limited, and he will talk about Kazakhstan's project on the digital currencies, the digital tank. Let's give him a warm applause.
You want to flip yourself again to the presentation, or should I come? You like that?
Thanks for coming to the presentation. Just a bit of an explanation as to why I'm presenting on behalf of Binur Zelenov from the National Bank of Kazakhstan. I'm the chief advisor to the chairman, Binur, who's actually the deputy governor at the National Bank. And I've been working on this project for a number of years, together with a wider team, a very assorted background, so I can explain more over drinks later. But the actual project itself has been running for a number of years. And here we just want to talk about sort of the project and some of the innovation and the developments over the last couple of years. So this is from the chairman himself. I asked him to record it. Can't be here in person, so I'm going to play it. Fancy dome in the background, so get that. Oh. Yeah. Audio? Do we have audio? Okay. Hold on. Let me back up. Okay, let's try that again. No.
We try it later.
Can I put it up here and maybe through the microphone, or?
Oversee the entire digital transformation program
Let me
in Kazakhstan. Dear ladies and gentlemen, it's a pleasure to electronically meet you. My name is Binur Zelenov. I am a Chief Digital Officer of the National Bank of Kazakhstan. So I oversee the entire digital transformation program in Kazakhstan, the important part of which is development of national digital financial infrastructure. One of the integral components of the national digital financial infrastructure in Kazakhstan is central bank digital currency, the digital tenge. So our journey is quite interesting. We started the project in 2021. We launched the proof of concept platform. And then we moved forward to the pilot with limited number of users in 2022. And in the end of 2022, we made a decision to actually launch the digital tenge and introduced the phased implementation approach. So starting from 2023, we are in production mode. At the moment, we already have around 250 billion worth of digital tenge in circulation. The key use cases are related to transparent public spending. We use programmability of digital tenge to enhance transparency of public procurement, government subsidies, and other types of public spending. We also, this year, are going to develop the DeFi component of digital tenge. Namely, we are about to issue CBDC-backed stablecoin in the economy, and this stablecoin will be then published at centralized exchanges, and we would effectively enable a bridge between traditional financial infrastructure and decentralized finance. I do believe that in Kazakhstan we developed very interesting approaches for CBDC implementation, and I believe we have something to share. And today John will share the specific details. I also would have my contacts somewhere here, so if you guys are interested, we always be happy to talk. Thank you, and you have a good day.
coffee or the drinks later on. For just a couple of introductions, in terms of the project itself, this was also driven by a lot of the innovation that is happening around the world, and we looked at a number of things in terms of initiatives that are happening, both cross-border initiatives, retail projects, wholesale projects, commercial activities around this. And one of the things that became obvious was, there's a lot of R&D projects that are going on, but also a lot of pilots, a lot of people piloting and testing things out and so on. We looked at reports from various entities. This is a summary of the things that are happening in Asia and the Middle East. So not so much in Europe and North America, but in terms of Asia and the Middle East, where is Kazakhstan in the grand scheme of things? Actually, very advanced, I would say, just in terms of, I'm not biased in any way, but my experience there, being there, and also with my colleague Vince, who's sitting in the back, who's also worked on this project extensively. Have been very impressed with the amount of digital innovation that's been going on, and driven as well by a lot of the initiatives around the digital money and the digital asset side of things. So this is just a summary from various reports, tells you a little bit about where Kazakhstan fits into all of the innovation topic. And what I was very surprised when I started working there is that most people didn't even know where Kazakhstan was, including myself. So actually, when I started going through this, it became very apparent that there's a lot of things that are happening in other parts of the world that we're not aware of. Digital tenge is a third format of payment in addition to cash and non-cash payments. And this is a very important thing because it sort of combines all of the properties of cash and online and basically digital forms of payment to enable new functionality that wasn't there before. And you'd ask, well, why do you need that? I mean, in the end, is there a reason for having this? And one of the original reasons, when I remember sitting with Benur at the very beginning of this project, one of the key reasons why they wanted to initiate this project was actually because of government payments to and state-funded payments to large corporations that are building sort of stuff in Kazakhstan, and they wanted to have a degree of transparency in the economy as to where public funds were going. And then the project basically pivoted as well into retail stuff, consumer-oriented retail payments, and we'll cover a number of those things in the presentation. So interesting in terms of what's driving the innovation that's behind this. Things like, and then very important topics, anonymity is a very important topic on the retail side, less so on the corporate side or the government public spending side of things, but again, important topics. They won't replace existing payment instruments. It's not the intention to just basically replace those, but to complement it and to enable new types of innovation. As Benur was mentioning, even this year, the kind of things that we're looking to do is to sort of expand this into wider types of capabilities in the marketplace with the stablecoins and commercial bank money tokens and so on, to enable the marketplace to be more efficient and provide more services. So those are the kind of things that we've been looking at as well. There's a few things to mention, I think, in terms of this. People sort of at the beginning of the project had a lot of concerns around anonymity and privacy from an end user perspective, and this is top of mind from a consumer-oriented point of view. Very important point, because this was something that people would, in terms of user acceptance in the marketplace, you need to make sure that you address this topic. And from very early on, it was by design, and things that were implemented were sort of taken from an anonymity and privacy perspective at the design level, at the very core. So there's a controllable degree of anonymity from an end user. I can basically, when I'm making a payment to you, for instance, I can control the amount of information that I share with you as a consumer. Different at higher levels of sort of government to sort of corporate payments, but at the consumer level, it is a controllable degree of anonymity, which is actually very interesting in terms of how, from a user acceptance perspective. Those are the kind of things that we sort of looked at as part of it, and obviously important to enable a lot of things in the market. As also Benur mentioned, in 2023, it was launched in a limited production mode, and it had a card scenario. So we worked together with card schemes and banks to make this more accessible to the marketplace. And there was an R&D environment where a lot of experiments were done, including cross-border payment projects, mBridge, and so on. We'll talk a little bit about that. Those two things complemented each other very well because it allowed an industrial or production grade sort of rollout of the solution, and at the same time, a lot of experimentation as well. So I want to pause here for a second because I think this is the first time we've ever seen this kind of implementation in the marketplace, especially with card schemes and banks and so on. It was the first one that we know of. I mean, I haven't seen anything else out there that allowed first project that allowed sort of the integration of the digital tenge into commercial banks. So at the beginning, these are sort of custodial wallets, so they're held by the commercial banks. So they're the ones that are holding the digital tenge. The view is that eventually these will become self-custody, but initially it was custodial wallets by the commercial banks. And we worked together with the card schemes, both Visa and MasterCard, and these 4 commercial banks at the very beginning of the project when it was launched in production, to be able to implement it and to roll it out. This meant that users can access their digital tenge right from their card interfaces and banking apps and things like that, and it made it much more accessible, also acceptable as well from the banks. So the resistance was initially there was a bit of it, but at the end it was very much well accepted by the banks that participated in this. And those were the banks that that started at the very beginning, and now the rollout is to expand that out into the wider market. Part of the reason to do this as well was to make the marketplace a little bit more equal. In Kazakhstan, there are it's a duopoly basically, 2 major players that control the majority of the market, and very advanced and very innovative from a digital innovation perspective, but the wider marketplace lacked that kind of stimulus or the ability, the infrastructure, the digital infrastructure that allowed them to be competitive as well. So this would create more competition in the marketplace for the other tail of other banks that are not sort of as advanced as those 2. So it created an element of that. And these cards are in production, they're live, they're real. It's real money. I have one here. It's real money on this. And it's basically allows you to spend digital tenge right from the card, and it could be it's a Visa card, so it will work anywhere. Very innovative, very different than other implementations, but at the same time sort of makes it much more acceptable for end users. Also, there's a wallet app. You can load it up with Apple Pay and Google Samsung Pay and all these things as well, so you can have it loaded up on your phone. The other interesting thing in terms of the project was the social aspect side of this. Part of this transparency push as well, and reduction of bureaucracy and elimination of corruption, as you can see from this. And you'd think, well, eliminating corruption in child lunches? Well, apparently there is some of that. And the idea was to make sure that every child that had access to state funds, which is all of the children, basically got a lunch paid for by the government. So it's basically very, much more distributed into the sort of the community. And the idea was to integrate sort of the digital tenge into this thing called an ONE card, which is like a transport card / school card. It had a multifunction card for students and a student ID card. And so that basically everybody had the means of payment at the canteen every day, so that they would not go hungry. And there was a discrepancy between the number of children getting lunches and the amount of money being spent. And this was a great way to eliminate that by providing a level of transparency. And it was a very good, feel-good project, actually, that part of it. The other aspect of the projects that the National Bank of Kazakhstan was working on, and the National Payment Corporation, which is a subsidiary of that, was to work on projects like Project mBridge as observer members, and then also working with the SWIFT and the CBDC connector as part of that project to experiment and to try out different things with regards to cross-border activities and integrate Kazakhstan into the wider global marketplace. In addition to that, there were also initiatives around DeFi with Binance and Kaze, which is the main stock exchange in Kazakhstan, to enable both sort of collaboration with Binance and the stock exchange for security settlement, and to enable that in terms of the market for additional capabilities for the market. In addition to that, there was projects around VAT. VAT is a complex topic, if you know about VAT, in terms of final product and VAT that's paid on it, and the merchants that are the companies, the commercial entities that are involved throughout the chain, collecting and dispensing or dispersing VAT and doing it all along the chain is a supply chain is a complex topic. And here it was something that would allow more efficient collection and payment of VAT for all the merchants that were involved in the chain, which actually is it's a time saver and a very good efficiency, market efficiency play. So that, just to summarize, I think in terms of the new sort of scenarios and functionality was, one is around sort of the enhanced tax management around the VAT that I just mentioned, including things like marked tokens. So the things where public spending tokens are marked, and then once they're sent and then put into the marketplace, at some point they get sort of unmarked, and then basically are no longer tracked and traced, basically. And I think that's a very clever way to deal with public spending in a more efficient manner, eliminating corruption and things like that. I talked about the DeFi part, and then also the different cross-border payments initiatives. There are many more that Kazakhstan's involved in, but the idea is to basically integrate Kazakhstan into the wider sort of region, but also on a global basis with other markets as well. So what's next? In 2023, we launched the production grade platform. It was limited production grade, and the idea was to then scale it out, which is created more in 2024. The focus was on testing a number of things out and expanding sort of the capability of the production aspect of it. And then this year is to fully launch this and put it into the wider marketplace. Now, if you notice, in terms of the use cases, this project was very use case oriented. We've picked specific narrow use cases and implemented it accordingly in order to be able to make sure that we addressed market concerns, understood sort of the retail, understood commercial, understood sort of the wider sort of implications of this. But the idea is that this is a multi-purpose, general purpose CBDC. It's not a retail or wholesale in terms of application. It's a general purpose one that can be implemented in specific sort of use cases and then launched more broadly, which is what we're doing this year. There's a lot going on. If I explain sort of, what I just showed you is a very quick snapshot of what's been going on in the project. The website has a tremendous amount of material. There's architecture documents to the nth degree. Everything is public. One thing that I've been incredibly encouraged about is the amount of openness about all the project work and all the project material, all the learnings, including the market surveys and everything else that's been done on this initiative. And I encourage you to read the documentation, because there's a lot of very, very detailed reports with a lot of information behind it. And if you're considering sort of all these topics in your CBDC journey, then there's a lot of very valuable material here for you to look at as well. Please, take a snapshot of the Telegram link, and then you can have access to all of that, what's coming up as well in terms of new developments. Thank you. Any questions? Yeah. Part-time.
Thank you very much, John. A quick question going back to one of your early slides and the use of Visa and MasterCard.
Yeah.
Does it I presume your digital Teng account has to be pre-funded with digital Teng, but if there's a deficit, will it automatically pull money from the commercial bank account?
You can program. This is also the capabilities that the banks would have to program as well. So obviously you can sort of sweep funds from your current account, your savings account, whatever, into the Tenge wallet if you need it. But that's a programming function of the bank. So those are the kind of services the bank could offer. And it would have to be initiated by the client at the end of the day, of course.
Choices in the commercial space, basically.
Sure. You could argue the question, well, what's the point of that, actually, right? And I would, if I were you. But the idea as well is that eventually these things can also, and I really glossed over it very, very quickly. The idea is that one of the primary reasons for implementing it, at least at the retail level or the consumer level, was to enable things like offline capability behind this. so that you would be able to have basically a self-custody wallet on your card or phone or app or whatever it is, in order to be able to make person-to-person payments using the digital tenge. Kazakhstan is a massive country, it's enormous in terms of geography, with a very, very relatively small population in 3 major cities, and everybody else is geographically dispersed. So telecommunications, network access, all these different things are very complicated in the country, and the ability and sort of payments as well. So getting state benefits to these individuals that are in remote and even nomadic, sort of because they roam around as well. A good portion of the population is nomadic. They have access to sort of the state funds. So how do you do that actually in this case? And this is where you can load up and pay through the wallet, make sort of these payments, and then once you have it, you can then make person-to-person payments even in offline and remote places as well. So that's part of the reason why I didn't mention it, because it's obviously.
So sorry, I have another question then.
Sorry.
For the offline payments, it's
Yeah.
really interesting. For the offline payments, what's the reconciliation part at the back end then?
You have to go online at some point, so there has to be some sort of, you have to do that, otherwise you then go out of sync. But the idea is that you enable it in order to be able to have certain amount of transactions that you can perform offline, basically with thresholds and limits, the usual story.
Thank you. I'll catch you later for all the other
Sure you will.
questions.
Any other questions? In that case, thank you so much.
Thank you.
Thank you. Let's see. Next up, we have Dr. Hatice Karahan. She is the Deputy Governor of Turkey, or Turkey. And let's give her a warm applause.
Thank you. First of all, thank you for this kind invitation. The presentation. Okay, it's working. Good. Today, I'll be presenting some of our innovation initiatives at the CBRT, the Central Bank of the Republic of Turkey, with a special focus on our CBDC work. So the research and implementation of technological advancements obviously play a crucial role for central banks in managing their core functions effectively, more effectively enhancing financial inclusion and establishing an innovation base within the financial system. Therefore, adopting these solutions is not merely a nice to have for central banks, but a necessity in the age of digital transformation. So in this context, we conduct research at the CBRT to identify pain points in the financial system and explore respective technological solutions, generating new ideas and uses in the process. And to test and refine these ideas, we conduct proof of concept, POC, studies. Efforts beyond POC, POCs often require expertise from multiple disciplines, making it essential to create environments where teams with diverse specializations can collaborate. So we have a dedicated R&D innovation team for financial technologies, and we carry out various digital innovation efforts by specialized subgroups under the topics of payment systems, CBDC, digital identity, e-money, stablecoins, and artificial intelligence. Let me start with payments. As a CBRT, we have been deeply involved in transforming the payments landscape in Turkey. One of our core functions is to ensure a healthy payments ecosystem that operates efficiently across the country. Beyond regulation, licensing, and oversight, we operate crucial payment and transfer systems, most notably the interbank payment system, which is not here on the slide. And it has been providing real-time transfer and gross settlement of interbank payments in Turkey for more than 30 years now, with various upgrades over time. What is relatively new in our instant payment system. We call it FAST, and you see it on the slide, along with its overlay services. Developed entirely in-house, FAST is a flagship project that revolutionized payments in Turkey. FAST is more than just a payment system. It is a digital public infrastructure upon which innovative solutions can be built through service layers. And a good example to overlay services is the QR code payment service, which has made person-to-person and point-of-sale transactions more secure and efficient. Other overlay services, as you can see on the slide, such as the escrow overlay and the request to pay services, can be viewed as forms of programmable payments. They demonstrate the potential for further enhancements and new business models. Let me also mention that we have collaboration with the Interbank Card Center, BKM, in the context of overlay services and open banking. For example, through the gateway Geçit, customers can enjoy open banking services. And all these products are live and operational. Stages for product maturity and related processes somewhat align vertically. In addition, whereas FAST is an in-house system, overlay services can be considered public-private collaboration. Let me briefly talk about e-money and stablecoins in the context of Turkey. Back in 2021, as a CBRT, we issued the regulation on the disuse of crypto assets in payments to diminish the potential unexpected spillover effects of crypto assets to Turkey's payment ecosystem. And while updating the regulation on payment services, electronic money issuance, and payment service providers, we added a provision to emphasize the technology-neutral characteristic of the definition of electronic money and to cover stablecoins that are one-to-one pegged to fiat currency within the scope of electronic money. So we're currently exploring a regulatory framework for stablecoins that could be considered electronic money. The next topic I'd like to highlight is artificial intelligence, which emerges as another powerful tool with a transformative potential, particularly for central banks. At the CBRT, we increasingly embrace the use of AI and machine learning for a variety of purposes. An ongoing in-house project, which is currently at POC level, automates tasks such as document analysis and reporting by LLMs. This effort aims to enhance efficiency by minimizing both labor and errors. And the next step could be delving into more specific domains such as compliance. Another project that we have is about establishing a system that enables the detection of patterns through models capable of identifying them. We have completed POC here and are moving to the prototype level. Another topic that I want to highlight is self-sovereign identity, or the SSI. Under the SSI and verifiable digital credentials model, users have the ability to selectively share their information only with the individuals or entities they want to share it with. And as part of the Digital Turkish Lira project, which I will talk about next, the digital identity system uses a permission distributed ledger designed for the SSI model. Digital identity actually is not a project of the central bank, but we are interested in many of the user scenarios, such as conditional payments. The digital identity system is essentially a registry for credential definitions and validity. The credentials stay with the users, and no identity data is in the network registry. Users store their credentials in their own mobile wallet applications in the context of the Digital Turkish Lira project phase 1. To elaborate, the KYC verifiable credentials will be retained by the users, and they are obtained through the financial intermediaries users prefer to register to the system. And these credentials can then be used for transactions across different intermediaries. So the transactions are independent of a single financial intermediary. So in our approach, a self-sovereign model is kind of integral to the success of a CBDC, as it is one of the main building blocks protecting user privacy. And now CBDC. Digital central bank money has entered our agenda as a natural consequence of digitalization. And once circulated, the digital Turkish lira is expected to make various contributions to our ecosystem. Let me start with the complementary payment channel. As I presented, the CBRT has payment systems available to all citizens through financial intermediaries and institutions. With the CBDC system, in addition to the circulation of bank money, that is used in the existing digital payments, the instant and 24/7 digital circulation of central bank money will also be ensured. Another contribution, as you can see on the slide, would be enhanced financial inclusion. Digital Turkish lira could be a significant opportunity to offer universal access to digital payment services, allowing citizens to operate independently of their registered financial institution. And thirdly, digital money would also serve as a basis for innovative use cases. We consider it a foundational element of the financial innovation infrastructure in Turkey. With the emergence of systems that can be built around digital money, let's say platformization of systems, we can move closer to this goal. And lastly, one other benefit can be mentioned that as the uniformity in digital payments, we envision CBDC as a uniform medium of exchange usable across all forms of digital commerce flows. Digital money may help achieve uniformity, addressing the fragmentation and varied payment requirements of current methods. So the goal here is to ensure that the nation's fiat currency remains seamlessly functional in various digital transactions, leaving the choice of usage to the citizens. We initiated our efforts for CBDC back in 2020 with proof of concept studies. Following the successful completion of the POC, the Central Bank Digital Turkish Lira R&D project was launched. While our bank possesses a well-established technical capacity for developing and operating RTGS and IPS, the expansion into digital currency, as you would appreciate, demands specialized expertise in cryptography, dedicated hardware, and various advanced technologies, which do not actually fall within the expertise of a central bank. So recognizing the need for specialized knowledge, we decided to collaborate with three national solution providers in our CBDC project. Currently, we are in our second phase, where we plan to address all the use cases and the requirements we have identified to be ready for the final issuance decision. That will be the third phase, along with the gradual delivery, of course, if the decision is to move forward. Let me now provide some details. On this slide, you can see the various steps we have followed to run the pilot tests for CBDC, from registration with 2 levels of verification to collecting feedback. The pilot tests involved real users and specific sale points. We named these pilot tests as limited pilot tests because they were based on prototype systems and the participation and duration were limited. But they involved real users who were not central bank employees, and they have provided valuable feedback on a real life experience. For the second phase, we work towards more mature systems and platforms and plan for user scenarios which will better inform the participants on the potential of digital money and identity. As we all know, gamification enhances engagement in the sense users who complete the defined individual or competitive tasks that you can see on the slide will receive verifiable credentials as rewards. These earned digital credentials can then be used to generate verifiable presentations, and depending on the scenario, they might turn into a discount in a programmable CBDC payment or a physical gift. For us, digital money will enable smart payments on a separate layer of programmability, and we prefer the concept of programmable payments over programmable money to better preserve the nature of money. The ability to program payments will certainly create new opportunities. Smart payments actually require not only digitalization of money, but also trade flows, financial assets, real-world assets, and processes such as identification. That's another issue that should be highlighted. So what we need here is not a system, but a platform. Assigning sole responsibility to central banks for creating smart payment flows may hinder innovation capacity. So instead, we are working towards platforms that integrate systems, enabling communication with predetermined standards and collaborative development environments. Although not definitive, the solution that we are leaning towards involves a decentralized common platform, and our current efforts align with this approach. What is more, in the programmability layer, payment templates can be created containing the conditions related to credentials and payment interfaces. Templates can be combined and presented for different use cases, and we expect public institutions and different licensed actors to take part in this layer, participating in the development and maintenance of these templates. This layer, the programmability layer, could also be considered an interoperability layer, connecting individual systems of money, identity, and asset under a platform model, which means that there will be many authorities involved, and the governance of both the layer and the programmability templates may provide challenges. Therefore, choosing the right model at this stage definitely matters. As you can see on the slide, we are also conducting studies on some future pilot test scenarios for programmable payments, including both the delivery versus payments scenario and the credential-based payment scenario based on various payment types. And we completed an in-house POC for programmable payments last year. The plan is that a PPP work on programmability will reach its prototype level this year. In domestic scenarios, interoperability is concerned with money and other assets. However, in international context, this relates to the interoperability of multiple countries' fiat currencies. Accordingly, the CBRT not only investigates domestic retail payments, but also delves into wholesale cross-border payments and efficient FX operations. We believe that the DLT is ideally suited for cross-border payments, as cross-border scenarios do not need a central authority, and DLT can provide a distributed platform both for settlements and governance. On the other hand, there will be numerous platforms and solution designs that should be interconnected rather than a one-size-fits-all approach adopted by nations. Therefore, we're exploring a solution that can seamlessly interconnect various cross-border platforms. And throughout these endeavors, our central focus remains on collaboration and standardization, both domestically and internationally. And currently, our experiments continue on systems developed based on a model of multiple common platforms integrated by a multilateral link platform. Our focus on the core common platforms is efficient FX operations and liquidity optimization, whereas the focus with their integration is on defining the steps for the inter-platform flows. We are designing the CBDC platform as a separate solution, parallel to our instant payment system FAST. There are, however, certain scenarios and integrations for the digital currency conversion processes. We have successfully tested a convergence scenario through FAST at the POC level, but I should note that there is no final decision on which CBRT payment system will be participating in the conversion. It could also be the RTGS based on further assessments. But additional points regarding IPSs and CBDCs could be: one, IPSs are tightly coupled with banks, but CBDCs need not be. Two, even as retail payment systems, IPSs might only have the wholesale ledger and leave many operations to the coordination of participants in the system. Three, CBDCs as legal tender can be accepted everywhere, as there won't be logistical issues the physical has. And lastly, CBDC is public money and people will have control over their belongings. At the CBRT, we also carry out simulations of the introduction of the digital Turkish lira to better understand the adoption process and the implications to the financial system under various scenarios and parameters. The model includes various actors such as consumers, merchants, commercial banks, central bank, and the government. And it incorporates parameters such as the percentages of cash, card, and CBDC expenditures, consumers' asset distribution, the status of bank deposits, interest rates, and the size of the economy. And we are continuously working on improving the model and identifying the necessary data. The in-house application at POC level has been completed last year, 2024. And the aim for this year is to have a model framework to help conduct insightful, policy-relevant analyses for understanding the macro-financial consequences of introducing a CBDC. It should thereby help us contemplate whether to introduce a CBDC, and if so, what design choices to consider. Well, simulating CBDCs is undeniably a challenge, since there are many performance and data-related issues, and simulation applications can get quite convoluted and become a product of its own. But as its nature is multidisciplinary, there is also a way to involve many departments and authorities as to simulate the real-life conditions as much as possible and build a more comprehensive solution. As I wrap up my presentation, here are the lessons we have learned from our CBDC work. The first one is simply that money is not already digital. Of course, bank deposits and credit cards enable payments in electronic environments today, but our view is that to support the anchoring function of public money, money itself, not just the payment, should be digitalized. However, digitalization will only make a difference if it can join the islands, systems, or walled gardens. And the essence to a CBDC is not simply building a more advanced payment system. It is digitalizing all money functions and operations and unlocking new ones by also removing the periodic requirements inherent in older formats. The second lesson draws attention to not only money, but also the surroundings. Digitalization of money is only a part of the big picture, and we believe that financial assets, real-world assets, and most crucially, identities should be digitalized. Here, we're not talking about electronic card identities or producing digital representations of documents, but more about decentralized identifiers. And this does not exclude the authorities. The authorities will still decide on the document definitions, and the issuers still issue the document. However, the verification process is not dependent on the issuer or the authority's infrastructure. And lastly, setting aside the discussions concerning the demand for retail payments, there are issues within the current international system that necessitate efforts towards addressing the cross-border use of CBDCs, as we all discussed. Therefore, we have accelerated our design processes to address the requirements of cross-border payments with a special focus on this area. Here, let me note that the development of the digital Turkish lira is an ongoing journey, actually. As with all their digital products, continuous improvement and commitment to absolute security are imperative for the digital Turkish lira. I had one more slide to wrap up all the topics I've covered, but I have far exceeded the time allocated to me. I hope the topics I've highlighted today have resonated with you, and we can continue having related discussions and strengthen our cooperation. I'll be happy to have your questions during the break. Thank you.
Thank you so much. Please correct me if there is any wrong with my pronunciation right now, but next up is Willem Ebanoize. He is the head of fintech at the National Bank of Georgia. So give him a warm applause.
Thank you. Very good pronunciation. Good afternoon, everyone. My name is Willem Ebanoize. I'm head of fintech and subtech development department in Central Bank of Georgia. So my speech is about digital innovation in Central Bank of Georgia, but I will be focusing more on CBDC projects. But since it's a kind of broader speech, I'll touch some strategic aspects of our activity. To give a little bit of context, why CBDC is a platform and why mainly we focus on competition angle, because banking sector is quite developed in Georgia. Actually, it's one of the key sectors which has been developed after the collapse of the Soviet Union. Especially two banks, TBC Bank and Bank of Georgia, are doing a good job, including expanding regionally. And I sometimes say that they have kind of competitive advantage compared to other incumbents in developed countries because their processes, their servers, people are as young as our independents, so they can absorb innovation quite a speedy manner like big fintechs. And in these circumstances, with the infrastructure projects like open banking, open finance, regulatory sandbox experimentation, CBDC as a platform, we aim to create playing field for newcomers, new entrants to the market. And that's why CBDC as a platform. Actually, it's a story how we are able to transition from why CBDC to how CBDC. I will walk through of our thinking process and our activities and how we differentiate. I would say is that we made this journey with the minimum resources, only 2 employees. We are full-time involved in this project, and we get quite useful learnings across the way, and I'm going to share this today. Of course, we had challenges along the way to come up with the solid, rational business case. CBDC is untested technology, difficult to pick the underlying technology. In short, lots of unknowns along the way. And key motivations as a small country. Wake-up call for small countries was Libra announcement a few years ago. Fortunately or unfortunately, lots of Georgians are still addicted to social media, and it is quite easily understandable if global stablecoin comes up, whether it will be affecting negatively or not to our currency sovereignty. That was one of the key motivations to start experimentation and researching in this field. But we spent a lot of time coming up with the solid business case and convincing ourselves that was kind of why part of our journey. Skeptics about CBDC would say that it's a solution in search of a problem, and we tried to find problem during our exploration and not be trapped in this dogma. What you see here is a use case matrix, which is often used in business strategy while introducing new products or new services by startups or established companies. And it answers question what is valued by consumer, whether the new use case, whether the new product is consumer pain point oriented. And here we visualize in short term, mid term, and long term our thinking process of bringing this framework into CBDC domain. You see here in the middle of this chart, T1 use case under technology enabled use cases, which is atomic settlements, which is not so much valued by consumer. That's why it is in the middle of the value curve. You can imagine in a long-term situation, then Internet of Things is a reality. Your smart refrigerator is connected to the nutritionist prescription. Nutrition is prescribed healthy food, and this healthy food reached acceptable limit in your smart refrigerator, and smart refrigerator gives instant signal to delivery company, and your foods are delivered. So lots of financial and non-financial transactions are happening in the future. Then Internet of Things and the related payments infrastructure is becoming a reality. And there is a promise that blockchain and underlying atomic settlements technology could serve this kind of reality in a better way compared to current infrastructure. But if you would ask 10 people in the streets of Tbilisi, 9 would say out of 10 that this use case is not relevant for them to serve any pain points, any current pain points. That's why it is in the middle of the value curve, not so much prioritized by us as of today. But to contrast with this, we have a short-term use case for early adopters, which you can find under smart contracts as free, which means that it is more valued by consumer, and use case is about selling property acquisition via smart contracts. The best alternative today is escrow accounts served by big banks. It's not expensive, it's quite expensive, as well as not all risks are fully minimized with this alternative. So with this strategy, we would build our marketing strategy of selling CBDC as a concept to the end user on the added value of this use case. And there is no need to come up with the additional marketing strategy, but to have visualized added value of the future financial system compared to the existing alternatives. So this is our thinking process, which visualize our short-term vision of this technology as well as long-term vision when kind of futuristic reality of Internet of Things is in place, and we want it to be early in the game. That's why we invested in this research. Also, in our case, it's quite important to have strategic fit with the overall fintech development strategy of prioritizing this kind of projects. We have 3 pillars in our strategy, fintech development strategy. Number 1 pillar is regulatory-driven innovation. Examples could be our open banking and open finance, when we have regulatory-driven open banking framework in place and now transitioning to open finance use cases. Or other example could be digital bank licensing process, when we require 10 times less capital for newcomers to the digital banking field than for ordinary banks. But besides this, we have 2 other pillars in our strategy. Second pillar is related to the infrastructure. Of course, we update our RTGS system. We make investments in instant payments, but strategy is art of focus with the limited resources. And we also invest in R&D of untested technologies like blockchain with this project. That's our second pillar. And the third pillar in our strategy is building ecosystem and building beyond Georgia ecosystem. Since we are quite small country and market is already quite competitive and concentrated, as I mentioned already, our commercial banks expanding regionally. That's why our message to fintech investor is to come up to Georgia and think about wider expansion from Georgia. And we are the one of the first central banks in our region who actually coupled fintech and ongoing positive trends in real economy, which is middle corridor. Because of geopolitics, trade is coming to this part of the Silk Road, and our strategy is that this trend could be even more accelerated if underlying financial technology serves the real economy, because you can transit goods from Kazakhstan to Georgia in 3 days, but with the current financial system still wait for payments next 10 days, or have pain points in trade finance. So, other examples, since we are at a digital Euro conference today, could be that last year, Euro celebrated 25 years of existence, and one of the board members of Digital Euro said the following: in 25 years, we can trade freely within the EU. We have no barriers of trade, but when it comes for paying of this trade, Euro arrived nowhere in 25 years. And since blockchain is quite disruptive technology, it's by nature technology-driven innovation, it has potential to be really disruptive, and it opens opportunity window for less developed countries, for developing countries. And that's why we are thinking about coupling these projects with ongoing middle corridor trend. That's kind of fit with the strategic vision, how this project fits in it. It took us 3 years to make the why analysis and to contextualize for our context this vision. It took us 3 years to come up to this one pager. And one pager is about having balance between solution obsessed versus problem obsessed, which means that regulators are kind of innovators' shoes in today's reality, and big mistake they make during introducing open banking other infrastructure is that their solutions, their APIs are less oriented to the real pain points. That's why it's quite important to be balanced between solution obsession and problem obsession. That's why we spent lots of time about contextualizing and answering why questions. Then bottom-to-up approach. We don't have a digital financial inclusion problem in Georgia. Financial infrastructure is quite developed. In difference of other countries which also explore CBDCs, we don't have one strategic reason whether we are exploring it for financial inclusion reason or not. But how we looked to this was we picked up promising technologies like smart contracts, tokenization, atomic settlements, and mapped with the most relevant use cases for Georgian case, which could be tax collection, which could be serving our immigrant-rich population, which could be making payments for merchant acquiring more affordable for few merchants. So when you aggregate from bottom to up, actually you get mix of rationales from financial inclusion to competition. Stakeholder-centric approach in our thinking process was very important to convince stakeholders to onboard, since we are selling in good sense this idea as a platform for experimentation to newcomers to the market. And in long term, we are not stick to any business model. And you see in the future slides that the knowledge we have accumulated during the pilot and testing actual technologies, we are now using for regulatory sandbox for tokenized deposits as well. So we are looking through industry development lenses and using this knowledge for other use cases which might be more widespread because of geopolitics of fintechs and because of global trends. I mentioned that we are managing these projects with only two full-time employees. And of course, we had lots of limitations. We had limitations from knowledge to finding financial resources and technology development resources for the platform. We took quite a risk-averse approach from the beginning to avoid internal bureaucracy. of central banking. What we did actually, we find technology service provider, which is quite a big name globally, and then we had minimum connection of their infrastructure to our critical infrastructure to stay risk averse and to have no connections with our operational risk and information security infrastructure, and also to avoid internal bureaucracy. As for use cases, our objective was kind of to do a modeling exercise, which means simplification of reality. For example, number one use case for us was salary disbursements for our own employees. So we would test programmability feature with this use case. We were able to onboard more than 200 employees of central bank for the experimentation, and the feature, technological feature we have tested for the use case in a wider world could be extrapolated to automatic tax collections, for example. Could be extrapolated to transparency funding. So our aim was, with the minimum resources, to actually create sandbox environment and test those technologies, which could be simplification of the future reality for number one use case. Second, to onboard more employees and more stakeholders, we introduced the use case on commemorative tokens. Collectible tokens, collectible coins are quite popular in Georgia. Georgians are quite gaming-oriented people in good sense, and we played on this. The game was regarding collecting different collectible tokens, and if you were able to collect 6 different collectible tokens, you would be granted one actual collectible token, and it's played well. We had so-called internal champions within the different departments who would spread the game across the colleagues, and this way we achieve participation of more than 200 colleagues in our game. It was quite a good experience. Third use case we tested in a limited scope was related to real estate acquisition on our CBDC platform. And we actually mimicked the actual process with the involvement on national public registry for real estate. And this way we get them on board, other stakeholders from the government. We made this use case for them interested. Same applies to our experimentation on tokenized government bonds. We were able to onboard Ministry of Finance in this experimentation. What played also well is dedicating resources to trainings and blockchain education. Our technology service provider was Ripple, alongside with EPAM, which is big technology company, and we devoted lots of senior management resources and technical resources, educating our employees and creating a learning environment as first step of the experimentation. These are testing results for each use cases, from payroll processing, commemorative tokens, real estates, and government issued tokenized bonds. Lessons learned so far following. We were able to onboard minimum practitioners. We were able to onboard a couple of big banks on this experimentation, stakeholders like Ministry of Finance and Public Registry for Real Estate, and created this sandbox environment with the participation of different stakeholders. And looking ahead and industry developments, overall sentiment around CBDC, we are now putting this learning in tokenized deposits in parallel of our experimentation. We just announced the regulatory sandbox for tokenized deposits 3 weeks ago, received quite an interest from local players as well as from international players, currently reviewing their application. One of the early learnings from the application is lack of knowledge of big picture, how they these applicants can use this opportunity to experiment on tokenized deposits beyond only experimenting on tokenized deposits, rather than experimenting on technology and building new business lines and new value chains for their existing companies. And we are sharing our knowledge via our innovation office, which we have accumulated during CBDC experimentation with our tokenized deposits applicants currently. So this is our story about.
Thank you so much, sir. So next up we have Alessandro Fraga. He's a specialist at the Central Bank of Brazil. Give him a warm applause.
Thank you.
There, that's you.
Okay,
Yes,
thank you.
thank you.
Thank you very much. And thank you very much, everyone, for being here. I'm honored, and I hope I can, in this time, pass to you how we want Brazilians to feel in a few years. So I invite you to feel like Brazilians for the next few minutes. This is a very user-centric presentation, okay? So I'll try to bring here the motivations of what we do, the state of play, and the next steps. Now, for motivations, we have a very high strategic agenda that the central banks follow for everything we do. So we have these pillars like inclusion, competitiveness, transparency, education, sustainability, and excellence. Mainly for innovation projects, we also follow this one. And for a little bit of history, right? We started with e-money back then, and with that we broke vertical arrangement. We fostered fintechs, but it was not enough. We needed a single rail for payments. And then came Pix, where we installed instant payments. We have improved the digital relation with the users and improved user experience. Then we have those two projects on the right side. Open finance, it's going on. We also aim to break silos, information silos mainly. We fostered fintechs more than with the money to improve the share of information and services. And now we have DREX. We are in this project in proof of concept phase. It's not up to the society yet. We aim for that for programmability and efficient in contracts, and also to improve user experience. I was very fast on this because, like I said, I want you to feel a little bit like Brazilians in the future. So this is your mobile. And those are can you see do you have a point there? The mouse works? Can you see the mouse? Okay. So now you have your mobile, you have your data wallet that has all your history in there. You have the services, underlying services that support you, Open Finance, Pix, and Rex. You have your consolidated position. This is important. Everything you own is here. Your money balance in each bank, your assets, everything you have to pay, future credit cards, payment flows, and all within the touch of a button on your mobile. And then you have services that you can access. They are here. You can access our services, your financial services aggregator. I do not say banks because it not needs to be a bank. It's just a head of a financial services aggregator to protect your access to the system, protect you against hackers, against attacks, okay? And it will show you the services that you want more. You can choose whatever financial services suits best you. You can have two at the same time. You can have one focus on a kind of assets and the other, on the other, you are free to choose and try everything. So you choose this financial service aggregator for those services. He knows you like those more and will present you in the first screen. If not, you need to access another one. You have freedom to choose. Let's say, one important thing, we are aiming for online and offline services as well. So let's say you need credit, okay? So I need a collateralized loan. I have treasury bonds, and the system checks that with all loans that will be possible with financial institutions, the system get you the lowest interest rate is 6% a year, and it will show you. You have the option, since you have the access there, assets there, treasury bonds, to access this collateralized loan, or you will have the option to, I want a loan without compromising any of my assets. It's a little bit higher. You have to share your data because you want to show that you're a good payer. If it's treasury bonds, the institution do not need to trust you. You can trust the system that he will be allowed to execute your loan if you do not pay. So this brings the credit price down for me at the end of the day, and that's what the central bank wants. Okay, and that is the low amount I want, the due date, and I put the information there, and this is sent to the system. If I want the, let's say, collateralized loan, I can also choose another asset as collateral, not stock options, but stock, right? I can choose in here. And so in the collateralized case, we can select other assets. As I said, the lender does not need to know who is borrowing. Of course, it will trust that the system will execute. And native divisibility of assets. This is important because your asset may be too valuable to give in collateral for, let's say, 1,000 reais, and your asset is worth 1 million. So you can have visibility and send only a part of your assets to the collateral. And the user limited can limit the data they shares. Of course, if I don't want to send any asset as collateral, I want the bank to trust me, okay, I can limit the data that's sent to them. It's okay as well, but the less data I send, the less information they will have, and the more the loan probably will go up. Okay, and in the case of the unsecured, of course, the lender needs to have POR for the risk, and the user control this information. So this is for me. Now, for the lender. For me, I have efficiency. I have everything in my hands. I have control. Everything that is sent, I have control. I have transparency of clear and transaction records. I have accessibility. Everything is in my hand, and satisfaction because everything will work. Now, for the credit providers, they have operational efficiency, right? We streamline the process. Everything is getting to them through the same system. They have risk management because of the collateral, because of the information. They have better risk management. They have regulatory compliance, adherence to KYC. They have attractive financial return adjusted by the risk they take. And also, this is important, they have how to refinance themselves. The loan itself, it's an asset. And the loan can be sent to the system for refinancing the financial institution. It's already in the same basket as everything else. For the services aggregator, that is a different hat than the lender. It's not necessarily the bank. It can be, but not necessarily. It's a participant that's specialized in knowing the customer, protecting him from attacks, and sending him the best first screen, knowing what he wants. So there is specialization, tailored representations for each client, operation efficiency, because Drex is handling all the infrastructure. Everything is native. And the service aggregator only needs to take care of the user. It doesn't need to spend much energy interacting with the system. It trusts the system, and the system will work as commanded. And also agility, because every new service that's invented by any other participant will get into this service basket and will be accessible on the first day. The financial services problem is to send to the user the ones that he knows that the user will use the most. So this is just a sketch of what we do behind the curtains, very high level. This is what we call wholesale Drex. It's the wholesale CBDC, right? And because customer A in here, in his wallet, is send money to customer B. Customer A is in a bank, customer B is in a PSP. The commercial bank money, or we don't have retail CBDC. It will be done with commercial bank money or electronic money, tokenized. And behind the curtains, the bank has to send CBDC to the PSP for this to complete. This will be hidden from the user point of view. He will only know that it works. I sent money, you received money, everything is okay by me, by the clients. So behind the curtains, we'll do that. And there are those services in here that support everything to the users. What is the state of play? This is our path. We started with some studies, technical group on CBDC back in 2020. We had, after that, we had some guidelines to follow. And then this is our lab where we tested the first concepts. And then we started the pilot. It's now a proof of concept. We call it pilot because we want to get something into the population eventually. But right now it's on proof of concept phase, right? We have the phase 1 that ended at the end of last year. We have a report about this phase 1. I will show you here the main achievements. Now we are at the middle to the end of the phase 2. We have a checkpoint of that in the middle of the year where we will assess what we managed to get until now and decide how we are going to go to in the future. In parallel with all that, we have the virtual assets service provider regulation. This is not tied to the Drex initiative. This is something we do in parallel because it's something we need to have today for the current system. In the future, we will adapt ourselves to this regulation and probably with minor tweaks on it, but this is something that the central bank has been doing in parallel with the Drex. For the lab, we had a wide range of use cases and participant sizes and types. This is important because we want to check everyone's point of view. What were the lessons of our lab? That no retail CBDC is required. PIX is doing its job already. For the user, it doesn't matter if he's using central bank money or commercial bank money as long as he is paying what he wants. He's sending and he's receiving, everything is okay. It doesn't matter for him the type of the currency. The potential exception for this is do offline. We have regions in Brazil that we do not have cellular coverage, and we need to do offline. This is something we'll tackle in the future, but it's a potential exception to this retail CBDC case. We learned that composability is fundamental for a project to make new services arrive to the user in his mobile easily, and that the systems with privacy were lacking in composability. So privacy together with composability, I can show you there, that is our fundamental challenge since the lab. It's our trilemma that we call internally. So we need to have decentralization as well as composability, as well as privacy at the same time. This is very difficult. We are trying to tackle this for a long time. And I will show you how we did progress on this. This is another quick picture. The first phase of the pilot was built in one use case only. We had a treasury bonds and a payment, one buyer buying treasury bond directly from seller. And this is how the treasury bond went from the seller wallet to the buyer's wallet. And then the money went this way from the retail directs to bank A, wholesale internally for it to complete. This is the anchor of the central bank. We need to anchor this in central bank money to make the system more reliable and stable. Okay, what were the lessons of the first phase? That the current ZKP, it's a cryptographic tool to make privacy work. They are not ready for production, despite going a long way in the phase. We had a lot of progress, but it's still, in the end of phase one, it was still not ready for production system. The maturity is growing, and it's really challenging to adapt the solutions to ensure privacy while maintaining composability. It was the same as we found out in our lab. Now, for the phase two of the pilot, we broadened the test scope. We brought in governance tests and third-party smart contracts. We invited the participants to bring their use cases and to build themselves the smart contracts, to test new business models. For privacy, we also opened this choice they would make, given use cases does not need all that in-depth privacy solution. Maybe a different kind of privacy solution is enough. We let them free to test. We also introduced new assets. Treasury bonds was the first case, and now we have a lot of new assets to test. And the lesson, this is partial because the lessons until now, we have until the middle of the year to try and tackle all the challenges we have, but some pilot participants still need from the central bank close guidance on architecting use cases, because they tend to mirror the current paradigm into the new one. And in some cases, they needed guidance from the central bank, and they went a long way on that. And that dilemma is still very challenging. We are still trying to solve those problems. For next steps, we have this, after we get to the trilemma and solve them, we have a lot of things to tackle. It's a long project, and there is scalability, instantaneity, defragmentation, AML things, interoperability, cyber resilience. So this iceberg, it pictures well what position we are, and we know we have a long way to go. We have supports from the industry, from the academy, and we need to get everyone together to go ahead. So thank you. I'll be available if you want to talk.
Thank you so much. And thank you to everyone who has presented in this session. There will be a 45-minute break in this room now, but we will start again in 45 minutes. Thank you, everyone.
Okay, let's start. So, welcome back, everyone. I hope you had all a refreshing break. So, my name is Ahmed, and I have the pleasure of moderating the next series of sessions. So, for our first presentation, will be led by Deborah Brooks, Chief Risk and Compliance Officer at the Wyoming Stable Token Commission. So, please, a warm applause for her.
Thank you. Thank you, Ned. Good afternoon, everyone from Frankfurt, and to those online. I appreciate the DEC inviting myself on behalf of the Wyoming Stable Token Commission to talk about a project that we, as well as myself, are very passionate about, i.e. the Wyoming Stable Token Commission. Now, I am from New York, and generally New Yorkers talk very quickly, so I am going to try my best to slow it down so that my New York accent doesn't confuse and or irritate some of you in the room and online as well. But before I begin, I want to give some very important disclaimers. As government agency, as you know, all the opinions and views expressed by me here in this presentation are my own and don't necessarily reflect the commission or the commissioners. Nothing that I say here can be seen or construed as giving legal, financial, or tax advice. Major decisions from the commission will be made by the commission, typically in a public forum. And at this particular juncture, although we'll discuss it a little later, no blockchain has been selected at this time. With that said, let's talk a little bit about who I am. Hi, my name is Deborah Brooks, and I am the first Chief Risk and Compliance Officer for the Wyoming Stable Token Commission. My position here began in September of 2024, so not that many months ago. But before that, I stayed for 10 years at an agency that maybe some of you know, called the New York State Department of Financial Services. I held many positions, but my last position was Deputy Virtual Currency Chief and Head of Supervision, where I supervised at that time about 30 licensees, including Coinbase, as many of you know, Gemini, Paxos, Ripple, BitGo, and so forth. And before joining NYDFS, I was a federal prosecutor with the United States Department of Justice. So that's who I am. Now let's talk about who or what is the Wyoming Stable Token Commission. What's unique about our stable token, as opposed to the other stable tokens that you are hearing about on a daily basis that are new and existing, is that we endeavor to be the first government-issued stable token. And the goal is to have it fully functional and in circulation by summer of this year. In fact, an announcement was made yesterday in DC that our token, which is preliminarily called WIST, Wyoming Stable Token, was issued on testnets yesterday on 7 candidate blockchains. The goal, like most stable tokens, is to be fiat backed, to be on a public blockchain, and redeemable for $1 US. Now, why Wyoming? Now, I assume many of you here know where Wyoming is. If I asked you where it is on a map, you can point to it. Admittedly, I did not know as a kid, but I do know now as an adult. Wyoming is definitely west of New York and east of California. And it's not far from Denver, Colorado. But the WIST initiative was created over 40 pieces of legislation beginning in 2016. This main mission at that time was to create a new revenue stream for the state that had pretty dependent and predictable revenue streams, but wanted to expand it to include digital assets. And as you can see in this slide, over the next several years, Wyoming and the legislature issued over 40 pieces of legislation designed and culminated into the Wyoming Stable Token Act that was enacted in 2023, so not that long ago. But as you can see, the acts that were passed leading up to the Stable Token Act of 2023 kind of falls into three buckets. You have the property rights aspect, you have the privacy rights aspect, and you also have the entity structures. Wyoming, I believe, is the first state that allowed DAOs to become corporations. So I think that's very new and innovative for a state in Wyoming to have such a robust forward-thinking approach to digital assets and particularly stable tokens. And as I mentioned before, as part of the revenue diversification, the Wyoming Stable Token Act was enacted in 2023. Now, as I've heard in this room and other rooms throughout the day, that stable tokens is a multi-billion-dollar industry. And by all designs, now that we have an administration focused on stable coin growth and crypto assets or digital assets overall, we can conceivably see $1 trillion in a short period of time. And thus, the reason why Wyoming is invested in creating and issuing a stable token. Now, this next part, I think Visa might disagree, but we believe and we take the position that stable tokens drive the majority of on-chain transactions, almost comparable to Visa. I'm going to talk a little bit about the structure of the Stable Token Commission. Again, created by an act in 2023 and comprises of 7 individuals. Now, really to demonstrate the significance and the importance of the commission, the commission is led by none other than Mark Gordon, the governor of the state of Wyoming. So as you can see, the commitment from Wyoming to have its governor, head of state, leading the commission. The commission is also led by 2 elected officials in addition to the governor. You have the treasurer and you have the auditor. In addition to the 3 elected officials, you also have 4 subject matter advisors who are key in the industry of finance, banking, accounting, and law. Another fun fact, the general counsel or former general counsel of Circle, the issuer of USDC, is one of the commissioners. We do have a budget, albeit not as robust as some other stable token issuers. We are small, but we are mighty. And so much so, I am here talking to you about the stable token issued by the state of Wyoming. We have been authorized by the Act to initiate a very robust procurement process. As you know, many of you may know about the process as everything, and I'll mention this later, probably more than once. Everything that we do is transparent. If you go on our website, you will see every meeting that the commission has, every decision that the commission has made. It is part of the Wyoming's belief in transparency. The citizens demand its government to be transparent, while at the same time wanting the highest level of privacy rights for its citizens. One of the, not even a challenge, but one of the assets that we are permitted to use as a reserve are cash, treasuries under 90 days, and repurchase agreements. Those are the only 3 assets by law we are required to invest in. So in listening to some of the discussions earlier, one of the concerns that was raised in certain presentations was trust and the lack of trust. By ensuring that your monies, if you buy with us, are limited to these largely secure assets, and I believe it's still safe to say that the U.S. Treasury is a particularly safe asset, that it will, if not build trust, but hopefully restore trust, and for whatever reasons people may have to distrust the government. Also, I mentioned earlier about the 9 candidate blockchains. 9 were selected, but as I said, as of yesterday, we issued on testnet on 7, including Ethereum, including Avalanche, and including Base. All of this, what I'm mentioning, is publicly available. If you type in Wyoming launch, you will see the full list of the blockchains that the token was launched on. Now, as I mentioned before, transparency. Wyoming statute is very clear on demanding transparency from its government, and thus we are required to enact certain rules and regulations through that standard. We are very open. We are very transparent for a state. Also, by the act, it requires us to be over-collateralized. Right now, the statute has a floor, if you will, of 102% buffer, but we're also looking internally about expanding that buffer because we want to avoid the volatility within the market vis-a-vis inflows and outflows, but we also want to prevent any form of a depegging event. Ultimately, like any good government agency, we have a public good. And what that means is the monies or the excess of monies, income minus expenses, will go towards our school systems in the state of Wyoming. So ultimately, the beneficiaries will be the children and the students in the state of Wyoming. Pretty good, right? Now, the stable token, or WIST as we call it internally, will be released on a public blockchain. That blockchain has not been decided, so I want to repeat that. It can be settled for dollar denominations anywhere on that blockchain within seconds. Wyoming is really an incredible state for its size. Another fun fact, in addition to being the home of Yellowstone National Park, also appointed the first female governor. New York just elected its first female governor this century. Wyoming did it a century earlier. Again, Wyoming is still the first state when launched to issue a stable token, which distinguishes us, I believe, from every other stable token issuer globally. But like all stable coins, we want stability. To use the example, I'm sure many of you have heard an article that was written in the New York Times a while ago about how a person spent $60,000 for a slice of pizza. Now, of course, the price of a Bitcoin was not worth $60,000. It was worth a lot less, thus buying the pizza. But as we know, because of the volatility of Bitcoin and other altcoins, you don't want to spend a lot for a pizza, thus the idea and the conception of a stable token to hedge against volatility, making it suitable for everyday transactions. Again, as I mentioned previously, we have the 102% buffer, and that seems to be in line with industry standards. I was with NYDFS when we drafted the stablecoin guidance, and I was in those rooms, and I was part of those discussions. And having that 2% reserve buffer really is a key difference in avoiding major depegging events. And I said this, and I still feel like I say, even though I'm no longer with the agency, we have not had a stablecoin issuer that is regulated by the New York DFS go under as a result of these pretty robust requirements. Recognizing that I'm not in the US, but talking about the US, we do have a pretty robust debt, and I'll just leave it there. And recognizing also that fiat-backed stable tokens, as requiring treasuries, really can help spur growth in the treasury market and really mitigate risk against any failed treasury auctions. I think someone also mentioned it earlier, about 90% of foreign exchange are settled in US dollars. But we also recognize that there are BRIC nations, that includes Brazil and the Russian Federation, that are seeking to be their own dominant players in the digital asset space or even in the financial sector. A digitized US dollar can also help and facilitate easy FX settlements and protect nation states and international players as well. Now, with every promise, there are challenges. Interestingly enough, I was talking to someone who's in this room about the lack of transparency in many of the discussions that we have. As a former regulator, as someone who's in the government, all we get is the good. You give us the presentation, oh, this is great, Deb, everything is great, rainbows and sunshines, and you just ask that one question and you kind of see the house of cards kind of fall. But for us here in the US, we do have challenges. From the first one being US regulation, there is none, not a comprehensive federal framework. It's been long overdue. We do have the Stable Act and the Genius Act currently in legislation, and the players or the representatives there are very committed to get some type of regulatory regime in place. Right now, the way the Genius Act and the Stable Act is written only applies to private entities. We're going to get clarity on that, but as of now, we are under the impression that it does not apply to state entities who are considering stablecoin issuance or those who are absolutely going to issue stable tokens like us. Another challenge is more on the state of Wyoming, not necessarily a national, which means for an agency, we have to commence rules. And rulemaking or regulatory or reg writing is a pretty lengthy process. Wyoming is no different. And the agency rules requires us to have at least a 45 business day public comment. As with any other asset or any other product in the digital space, you also have to have a robust security. Because as you know, you're as good as you're strong as your weakest defense. And if your technology is lacking, then as you can see, as we read, you're going to witness hacks, you're going to witness exploits, you're just going to see a host of problems that will befall your agency. And another challenge, again, interestingly enough, in one of the panel discussions earlier that I sat in on, talked about education and the importance of it and educating people. When someone asks me what's a Bitcoin? I'm like, that's too long of a story, but if you really want the 3-minute version, I tell them to go on YouTube and type in The Simpsons, I'm not kidding, The Simpsons and Bitcoin. It is a great explanation on, if you want to explain to anyone what Bitcoin is, that is the perfect explanation, and I highly recommend it, and now it's on the record, I recommend it. See, I don't have much time left, but use cases. And again, we've been discussing throughout the day the prospective use cases, institutional, retail, as well as international. For me, and on behalf of, or as a representative rather, of the state of Wyoming, we start local, but I think forward and I think global, thus being here. So we see the stable token being used in stores for purchasing products on the retail perspective, but we also recognize that it would have very strong use and utility in the DeFi space. So we envision the stable token to encompass me at a supermarket buying a cup of coffee versus me buying it and using it as part of a DeFi protocol. Next steps. Actually, it's happening right now. We have engaged in at least 7 qualifying vendors who are very robust and extensive RFP or request for proposal process. As I mentioned more than once, we have partnered with Layer 0, who have helped us launch on testnet our WIS token on 7 candidate blockchains. The goal is to release and to have into the wild, as we say internally, by this summer for a fully launched stable token. And we're not just limiting ourselves to one blockchain. It is our intention, or the commission's intention rather, to expand into multiple blockchains. So to scale as quickly as possible, but also, and I can't stress this enough, in a safe manner that protects your assets and also protects consumers. In the 25 seconds I have left, please stay in touch. If you click on this QR code, it will pull you to the Wyoming Stable Token Commission's website. As I said, we are very transparent. everything, including the commission meetings, which are recorded, are listed in this website. And with that, I will say thank you. Thank you very much, everyone. Have a good day.
So thank you so much. Any questions?
Oh, okay. Oh.
So, oh, wow, it's really loud. I don't know if you are able to answer this, so no worries if not. But I was just wondering, because you mentioned thinking about it as a global use case as well, and obviously completely understand limitations around backing assets for a state-level stablecoin. What do you think, though, about potentially, the Wyoming stable token, but denominated in another currency? Because we also talked about earlier, the need to have local currency for local treasuries and things like that. Do you think that's something that for the future could be a hypothetical?
Well, again, this is my own opinion and not of the commission's. Obviously,
Totally fair.
we are a state within the United States. So, of course, in the first instance, the fiat would be US dollar. I believe that's consistent with 90% of the stablecoin use cases. But that doesn't mean down the road, as we are in the $1 trillion phase of stable token issuance, we can look into other denominations besides US dollar.
I think it would be really cool and competitive.
Yes.
So let's see what happens in the future.
I appreciate it. Thank you.
Thank you for the really interesting presentation. Again, on the topic of the global use cases for the Wyoming stable token, how are you working with other global regulators or keeping an eye on what's happening in other jurisdictions to ensure that in the future WIST is usable in other jurisdictions as they introduce their own stablecoin regimes and potentially requirements for, foreign issued stablecoins and things like that?
Thank you for the question. For starters, having me here, talking to people like yourself and listening to other presentations and understanding the landscape. We travel, whether locally or internationally, to have those conversations and not just limit ourselves to the state of Wyoming. We recognize that for us to scale and scale rapidly and safely, we can't limit ourselves to the four corners of Wyoming. We want global adoption, and such. We do talk to regulators, not only within the United States but also in Europe. Yeah.
Sorry. So which one would be your? Who would be? Who?
Oh,
would,
I'm sorry. I was looking at her.
Oh, okay. All right. Okay. So
Sorry.
my question is if I buy a stablecoin from you, who is my counterparty? Is my counterparty actually the state of Wyoming? Are you guaranteeing it entirely as the state of Wyoming, or is it only guaranteed up to the assets that sits of the 102%? Or how does this how strong a stablecoin do we have here in terms of coverage?
Well, in terms of coverage, you're kind of asking like a two-part question, so I'll try to answer it in two parts. One, we are not dealing directly with you, so you could not, as a retailer, approach us. We, because of staffing, because there's only 5 of us, and you're meeting 25% of the staff today, 20%. I need to do math. Yes, I was. Math, well, never mind. 20%. Yeah, I know. It is late in the day. 20% of the staff you're meeting. So you would have to go to an exchange and buy from them. So our counterparty would be the exchanges, for example, or resellers in general, if that makes sense.
Okay, so the stability of it's going to be handled by market makers and stuff like that,
Potentially, yes.
rather than a direct sort of
Directly,
against
yes.
you.
You would not, as a
I'd not be able to
retailer-
call the state of
No.
Wyoming and say, God, I need my dollar back.
No, you would call hopefully Coinbase and order the Wyoming stable token from them. I'm just using Coinbase as an example.
Okay, and there's no redemption guarantees.
There is, because the statute requires redemption, but there are exceptions up to the dollar, but there are like limited exceptions. If the Treasury Department, for example, folds. So obviously
Sure.
we couldn't, so that's just one example, but the rule is, or the act dictates, you gave us $1, we have to redeem. you back a dollar. Generally, but minus those exceptions I mentioned.
Okay, but via Coinbase or other types of.
Generally, yes. Your redemption process would be through the resellers. Yes. And I think to your second question, the Wyoming is it's not like the U.S. dollar where the U.S. dollar is backed by full faith and credit. It's a special purpose, but the act does require us to redeem for a dollar. Okay. Oh, hot bench.
Thank you. Yeah.
I think we have one more.
We may take the last question. Yeah, please. Go.
Thank you. Thank you so much for the session and the presentation today. You obviously have first mover advantage. You don't currently have federal legislation in the US. Do you see there being a risk and to what you have proposed and how you're structuring your stablecoin, depending on what comes out of the federal jurisdictional layer?
Well, as you know, the United States do have a dualism where the federal and the state entities run parallel and largely independent of each other with, of course, exceptions. What we plan, and we have been monitoring the Stable Token and Genius Acts, and currently we are not worried about interfering with our federal partners. We want to work, as always, collaboratively with them and ensure that we are not running afoul against any rules and regulations that they enact, even if we are not subject to them. Thank you. That's it.
Thank you.
One more?
Yeah.
Oh, I said one more. Okay. Was this like the
we
most active of questions today? You can lie if
So,
okay, thanks.
Yeah. So how do you think the regulations can help to mitigate the, for example, money laundering and sanction risk when it comes to stablecoin use cases?
So your question is, let me see if I understand your question. How do the regs help with compliance?
Yes, compliance to money laundering and sanction standards. How the regulations of stablecoins can help with that?
Well, that's what I'm working on, ensuring that our rules really are consistent with FATF, with the BSA AML rules, because as I said, one of the concerns as an agency is reputational risk to the state of Wyoming. You just don't want to hear that your stable token is used in illicit activities, that it is part of CSAM, terrorist financing, and so forth. So as for me, as my role is, and I've been working on this and having those conversations, is to come up with a protocol that will ensure that not only the right person uses our stable token, but uses it in a legal and safe manner. Thank you.
Thank
No
you
more
so
questions,
much.
or just?
Yeah. Yeah, we are run of time.
I think we're out of time, but I'll stick around if you have any questions. Thank you very much.
Thank you so much. Thank you for this insightful presentation. Yeah. So for our next presentation, so for yeah, a lot of questions. So, yeah. Thank you so much for our next presentation. Please welcome Aniko Zombati, Chief Digital Officer and Executive Director from Southern Bank of Hungary. Please a warm applause.
Thank you for staying with us for this late timing, physically and also online. And in the next session, I would like to introduce you the single retail CBDC pilot that existed within the European Union. Actually, it was running from May 2023 until this February, and we have a lot of takeaways, and I would like to present about that. So first and foremost, how the story started. Actually, our management wanted us to have an initiative which is a little bit smaller scale, so it's nothing to do about the generally applicable retail CBDC, but a definite smaller case use case where we can actually field test what does a CBDC introduction mean for a central bank. So we came with the idea that we should target the primary school age children and their families with issuing a CBDC and helping their journey on digital financial literacy and inclusion. And via this use case, we can issue a real CBDC, direct liability of the Central Bank of Hungary, and we can actually learn about how this affects the whole organization and what are the main working processes during this journey. So, as I said, in May 2023, we launched the Student Safe, and it was applicable for the children who already have their own finances, who are very digital, but they are underserved by the banks, first and foremost because of legal reasons, so they are not eligible for having a bank account individually. So we offer them a free digital wallet. Why I'm saying a wallet? Because we are actually issuing an e-money. So we identified the really narrow line in the legal framework. The EU e-money directive actually allows the central banks to issue an e-money. And in this way, we were not held back by any legislative processes, but we could launch the project right away. And so the project was realized actually in about 16 to 18 months with different procedures. So we always in these CBDC projects, the technology part is the simplest work stream. And apart from that, we had a user-centric work stream about realizing really cutting-edge UX UI, because in the world of CBDC, it's not only about what the central bank wants, but it really has to offer something really appealing to the customers, which is as convenient, as safe, and as appealing as any other market-based solutions. But apart from that, we had to prepare our organization for the operation, and of course our own team to cover all the work streams and all the processes that we require from the market participants to cover according to law, especially KYC and AML coverage. So what we worked out was really nice, well-functioning digital wallet with all possible functionalities, so QR code payments, instant transfer connection, request to pay, piggy bank functions, and all this represented in the balance sheet of the central bank. We also included conditional payments, which was motivated by the possibility that the parents could control the payments flow of their children, and they could directly give them tasks, and all the transactions and messages were conducted via our app. But we not only offer the cutting-edge digital wallet, but we thought that we need an extra motivating factor behind the scheme, which differentiates our wallet from other market-based solutions, and it was organized around the student coins, which were nicely designed digital coins at the beginning, and they were distributed in return for solving quizzes about financial literacy, digitalization, sustainability. And also every month the parents were given free of charge 500 coins to use it and transferring it to the children either unconditionally or via giving task and setting conditional payments. And at the end of the day, all these student coins could be redeemed at the biggest e-commerce provider, the eMAG, in the form of any purchases present. So it was actually a free gift from the central bank in return for learning and in return for being active on the app. We also covered the KYC AML by our own, meaning that we had a special team and a special regime, actually a two-step process. So it was the first grade could be accessed only by providing the email address, and this let the users to use limited functionality, and for the full functionality, a full KYC was required. And so the whole architecture of the project was modular, and this not only helped us in risk management, but also it provides a future-proof framework, meaning that any of the parts can be exchanged. For example, this is a centralized ledger system, but it can be easily converted to a DLT-based structure. What you can see here is that the majority of the project was under the central bank, but we had very valuable partners. First and foremost, we had the commercial banks in different roles. So as we were issuing an e-money, we needed a custodian bank, and this custodian bank was a commercial bank, and they were not only custodying the cash leg of the e-money, but they also provided us direct connection to the instant payment system, meaning that users could redeem the e-money 724. We also had a commercial bank who provided us the VPOS possibility to top up the accounts with card payment, and also we used the QR code-based payment scheme for the payments part. Overall, we were coming out with a scheme comparable to any market-based solution, and we had very diverse challenges during this journey. First and foremost, from organizational point of view, we had to orchestrate the whole system within the central bank, including compliance, accounting, every area. I would like to highlight that these teams never had the task to operate any customer-facing functionalities, so it was a completely novel exercise for them. We also had to be open 724, and this is also an unusual, usually for the central bank. So before that, we only had the homepage as a 724 accessible system. We need to learn how to work in an agile method with our partners, because the vendors who served us were two Hungarian fintechs, and also the commercial banks are usually operating in an agile mode, so we had to forget about waterfall as much as possible, and we had to do our own homework and work out all the reporting, monitoring, KYC, and notifications functions. From architectural point of view, we had to find the proper place for the system within the central bank infrastructure. Of course, it had to be extremely safe and resilient because we were issuing money, but actually, in reality, it was not connected to any, let's say, high security core central bank infrastructures like RTGS. Even though our fintech and banking partners are already working with the cloud environment, the local regulation required us to implement an on-premise solution because as a central bank, we are not allowed to use any cloud-based solutions. Still, we had to implement and operate the API connections to our commercial bank partners. And we not only had to be open, but had to be accessible 7/24. So we had to guarantee a high level availability. Also, it was a novel exercise for our fintechs to actually work with the central bank because our IT security team set really high standards from the outset, but also I have to admit that they were also coming up with new and higher requirements during the process. So it was a real challenge for the fintech vendors. And finally, we had to go through multiple vulnerability tests before the launch to the general public. And lastly, as central banks never interacted with retail users, and especially not with children beforehand, we had to pay really high attention to the cutting edge UX UI and learn about design thinking. We also had to hire experts with banking experience to cover all the customer-facing functions, complaints, queries, registration, which doesn't entail anything for the future, so that we think about a tier 1 CBDC in the future, but it means that we had to explore what these tasks actually mean in practice and learn about these requirements to be prepared for any future tasks. And also, we paid really high attention to frequent interaction with our user base, and we not only interacted, but we were asking for their feedbacks, and based on their feedbacks, we implemented fine-tuning modifications continuously. So actually, we were running the project and got very prestigious international recognition. So last year we got a prize from central banking publications called CBDC Initiative of the Year. And also locally, we got a special prize from MasterCard in the Financial Solution of the Year for Young People category in the Bank of the Year gala. So even though no trees are growing to the sky, so the tough reality came actually last autumn, when the government banned the usage of mobile phones in the primary and secondary schools in Hungary, meaning that it was a serious jeopardy for our use case, also in peer-to-peer transactions in between the students, and also in the QR code-based payment plans where we have seen that the main use case is that the children could pay in the school canteens. So first, this let's say, news and also the rapid development of the digital euro prompted our management to reconsider where the main focus of the central bank is put for the future. So as the digital euro is developed, with the idea of monetary sovereignty in the hindsight, our management wanted us to consider rather a more general solution and work on the idea whether we need anything like a digital forint for monetary sovereignty consideration as well. So overall, the system closure was announced in last December and was, let's say, orderly shut down by the end of February. And there are some general takeaways, and I would like to highlight some of these. So, of course, it helped us to present a solution at several international forums. And also, we were successful in rapidly implementing the system because we could rely on the existing legal framework. So we didn't have to rely on actually the support of the parliament or politicians and engage into sensitive discussions on privacy and the need for a CBDC. We could also rely on the specialty that as it was a pilot, we could move fast and we didn't need to care so much about the edge cases, and we were definitely not building a Death Star for unlimited time, but we could release the solution pretty soon. I would like to highlight this, that we were not jeopardizing the business objectives of the commercial banks. We were working in close cooperation with them. I think this is one of the main threats of any other CBDC initiatives, that the central bank expects the commercial banks to innovate, to work, to invest, even though the CBDC itself is jeopardizing their own business model. We were also offering an extra motivation for use. So we were not just another digital payment solution, but we distributed presents and we were educating our user base. And we were, of course, using the feedback as a very precious news and could rely on that. So currently the system is in our test server. We had some ideas where it could have been developed. So we could implement the offline part into it. We could also create an SDK and test the hybrid CBDC model in cooperation with the commercial banks. We could also implement a card-based system because this is the most prevalent, well-known digital payment solution. So to boost adoption, this is a possible way forward. We could also introduce an investment connection, and of course we had some plans also to include programmability functions. So overall, if you would like to learn more, you can access our white paper via this QR code. So thank you for your attention, and if we have some time, I'm open for the questions as well. Thank you.
Thank you so much. Thank you so much. Any question? So.
About the app, about the app, but
Hi. Yes, so I have a question, and it's related to the fact that you mentioned that it's banned in schools to use mobile phones, for example. So that's why this, of course, has an effect on how students could use or could not use in that case, to pay in canteens, for example. So I was wondering what would be a solution for that? And I was already thinking about it. Could that be a potentially like a debit card or a credit card, which is not a mobile app, but actually a card which students could use to potentially pay in the canteen, but still connected at the back end, for example, with potentially the CBDC. So just wanted to understand if that card functionality was also on the agenda. I know it involves POS terminals that need to be set up and so on and so forth. But as next steps, are there ideas about how this could develop, given that mobile phones are still banned in schools?
Okay, thank you. So as I said, we were considering the virtual card, so embedded on the mobile phone originally, because this could help adoption. But physical card is a little bit more complex because it's like the very same as other companies like Revolut are already offering and distributing. So nothing special which our model could be supported by. So just to highlight that the problem with the ban was that our main direction of marketing was via schools. So we entered schools, we motivated schoolmasters to promote the scheme and use it. So it would have needed a main overhaul of the whole project if we wanted to accommodate this ban.
Thank you so much. Yeah, we are running out of time. Yeah, thank you.
Thank you.
And let's please close. Yeah. And let's move to the next presentation from Derek Kruvanus. I hope I'm pronouncing it right. Yeah, thank you. So here's our tokenized securities from BX Digital. So the stage is yours.
Perfect. So then just perfect. So good afternoon, everyone. Yeah, thanks for your interest and your time to have to stay here. So normally I'm working around a little bit, but yeah, okay. Thanks for your time and the interest and your endurance after a long conference day, respectively 2 conference days. I would like to take you on a little journey to Switzerland, and I try to speed up, that we might gain some time back. My name is Dirk Kruvanus. I'm working for strategy department of Börse Stuttgart Group, and within that strategy department, I'm focusing on DLT financial instruments. That means on the question how we as exchange will become DLT ready, how DLT will affect our business, and what service we can offer in the future. So, and in that context, I'm closely working with the colleagues of Swiss colleagues of BX Digital, because BX Digital is shows the answer on our understanding of the future of capital markets and how we as exchange can position there. So before starting our journey, just a short overview of our group. So we are history of more than 150 years, and as exchange, of course, the core business is exchange business. So we are operating exchanges in Switzerland, mainly in Germany and in the Nordics. Have a own broker within our group, so acting as market maker at our exchanges. Beside that, we really early stepped into the cryptocurrency business. So colleagues were there also yesterday at the conference. So we have a retail cryptocurrency trading app, and we have also institutional services for the infrastructure and the crypto within the cryptocurrency, so from brokerage and custody. And you might have read about our announcement with DZ Bank and DK Bank. So the third pillar now is what we call tokenized asset or DLT financial instruments. And that's, as I mentioned, the answer and how we will position ourselves in the future. And yeah, so there BX will show how we can approach. And we heard about the last 2 days a lot about the momentum in the DLT financial instruments. So we see a lot issuances last year, also thanks to the ECB trials. And in that context, we see a lot of new players coming into the market and building infrastructure and doing first steps into that topic. But one piece of the puzzle, at least one piece of the puzzle is still missing, and that are secondary markets. And that's exactly what we are heading for and what BX Digital is going for. It was just last week and when we could announce that we got the first ever granted license by FINMA, so-called DLT trading system license in Switzerland. And it's a little bit misleading. So it's not only DLT trading license, but it allows us out of one hand offering trading and settlement of DLT financial instruments. So that's a little bit that's comparable to what we see in Europe under the DLT pilot regime, the DLT trading and settlement system license. The difference is that in Switzerland we are not anymore in a pilot regime, but it's finalized, and that means that we there do not have the limitations we see in Europe. So that means we have the possibility to trade DLT financial instruments multilaterally, and also then having the settlement directly combined with the trading without the need of the CSD, and so doing that on the DLT. I just come on the next slide to how the processes and the pictures, the setup will look like, but that's the core of the license. So we have now the license, so that means we are preparing the go live, and for that we are currently onboarding the first trading and settlement participants, and then we have, as you see here, a pipeline of about 40 listings that will then come once started, and the range is very wide from tokenized DLT bonds, let's call it that way, to money market fund. We heard a lot the last 2 days, going further to some kinds of private equity access via the DLT products, also some kind of real world assets coming along. So a quite interesting combination of traditional topics and also topics that are not yet that existent in the traditional world. Even if at its core, it's nevertheless a bond or a equity that's from a regulatory perspective behind the security. So, and how is our understanding of this DLT infrastructure for trading and settlement? So as we already operate trading venues, so we see that the trading works very good, perfectly in the off-chain world. So we have existing trading systems, we have existing trading participants. So, and our possibility and the USP is, of course, that we can leverage that. So that means every trading participant we today have at our trading infrastructure can be easily adapted to the world. We do not need a new connectivity. You do not need a big IT project to onboard, to have the messages, how to send orders, whatever, it's the same. So we keep it off chain. And once we have a match in the order book, then we do not go the same way as today. So it's not routed to a CSD settlement, but it's routed to our DVP settlement solution. And this DVP settlement solution orchestrates the settlement peer-to-peer. So we do not have a central depot or central wallet function like the CSDs have. We have a peer-to-peer setup where every trading and settlement participants bring its own wallet to the table, and then we orchestrate the asset and the payment leg. And as we participated last year at the ECB trials, got 6 bank, they followed our use case, and we could do a lot of tests there. And the feedback from that banks and also from the market is that we currently the feedback is that it's central bank money is the focus for the payment leg. So if we found a way in fiat central bank money, that's preferred at the moment because stablecoins, commercial bank money tokens are not yet there at that stage to use it for capital market transactions. And on the other hand, of course, we do not have a wholesale CBDC. So we have this, the requirement of the market to settle in fiat central bank money. And we solved that. You see it here in the picture in Switzerland. So we have direct access to the SIX system. So that means how the settlement works out like that. It's a step-by-step delivery versus payment process. We, from the seller wallet, we took the sold tokens, have then they are locked, let's say, in the settlement contract, in the DVP smart contract. Once we have the token locked, then we can directly trigger the payment between the buyer and the seller in the interbank system in Switzerland. Once we got there, then the message back, of course, that the payment was executed, then we can we inform, let's say, the smart contract, and then the locked token are transferred to the wallet of the buyer. So that means we build on the one hand side a infrastructure that uses as many puzzle pieces as of today, so especially with regard to the trading, and then combining this with the DLT world, and then we have this decentralized peer-to-peer settlement, no central parties in between, especially with regard to the wallets. We build it on a public infrastructure, public blockchain, so that means Ethereum, advancing then the next step Polygon, but we are agnostic on that side, so we can add different chains, so it's permissioned or it's private or it's public, so that it's possible. On the other side, we can also add different payment ways. So as I mentioned, for the time being, it's a bridge to the fiat world, but if at one time, at one point in time, the market agrees on stablecoins, or if we have a wholesale CBDC, then we can switch, because in the future, of course, the future final picture is that you have everything on chain to have the full efficiencies of the DLT in the whole process. So, but so that means also we have no pre-funding as of today. We use existing payment rails. The banking know how to handle their central bank money accounts. We have no counterparty risk, because we settle in real time, near time, within 20-30 minutes. It's settled, and then we have this whole setup is, as we got the FINMA license, fully regulated. Yeah, so from our roadmap, we started the whole process 2 or 3 years ago, having the first proof of concepts. Then we, of course, build it up. The whole license process took more time than expected, but I think that's the normal way if you're the first one getting such a license or applying for such a license. So now we have the license. The go live will then be in the next few months, starting with this universe I just showed. And then, of course, it's the goal to expand it, to expand the ecosystem, the numbers of listings, numbers of trading and settlement participants. And for us as a stock exchange group, coming mainly starting in Germany or Europe, that is then will be our blueprint to go for Europe. So, and as I mentioned, it should be a growing ecosystem. So, of course, we have now the first trading and settlement participants. They are currently onboarding. We have a roadmap and a pipeline of securities that will be listed there. But of course, we are working on expanding the ecosystem on at every side. So on the sell side, buy side, asset managers, the products, also market makers will be included in the system. So that's our idea and the goal to extend this ecosystem to have a vivid and frequently traded ecosystem on a multilateral system. So that was already a short trip to Switzerland and to the idea of setting up multilateral trading and settlement in a DLT world. And if there are any questions, either now or just the contacts, colleagues in Switzerland or myself, and yeah, happy to answer questions.
Plan to set up something similar in Germany?
In Europe. In Europe.
Yes.
Yeah, currently the license is yeah, exactly. The license is for Switzerland, and as Europe and Switzerland are not harmonized in all the regulatory topics, so it's not easily to be passported to Switzerland, so to Europe. So we have to go for other licenses in Europe. And as in Europe you have the issuance, that is a national topic, but coming to multilateral trading and settlement, there you have the European laws.
Why choosing Ethereum and then going to Polygon?
Yeah, so the Ethereum, I think Switzerland is very Ethereum friendly. So that was the starting point. We started the POC on Ethereum and we kept that because it was then built. The infrastructure we built itself is EVM based consequently. And so we can easily switch to EVM based chains, private, permissioned or permissionless. Why then Polygon? Because just looking at the market, especially in Germany, if you see the issuance of a DLT financial instrument or crypto Wertpapiere called in Germany, so yeah, going through the number of the issuance, I think 60-70% of the issuances so far have used Polygon. And therefore, we're building for the market, the infrastructure, and the market currently is there. But as I mentioned, we are agnostic, so we can add further chains and integrate that.
And then, don't you worry about the scalability?
Pardon?
About the scalability.
Scalability?
Yeah.
I'm not worried. It's a challenge because, of course, the ecosystem, you need a critical mass. Our advantage is, as I mentioned, we have existing trading venues in place. So to our traditional exchange, all German banks are connected. So the question of scalability is is more adoption topic. How we make this adoption as easy as possible for all of our existing and new trading participants. And there our answer is to have this hybrid or combined setup of using as many aspects or pieces of the puzzle off-chain and existing things, and then add the new things.
Thank you.
Thank you so much.
You're welcome.
Yep. So we can move now to our last presentation from Alex Gulau, our co-founder and CPTO at Parfum. Please. Go ahead.
So is it already here?
Just
okay. Hi everyone. I do have a presentation. It's not this one.
It didn't receive.
I didn't receive it. I have my laptop. Is that?
Yeah, of course. We are, especially us in the lunch break.
HTML.
I guess.
Hi everyone, and thanks for staying until the last presentation of the day. We went from now Switzerland to Brazil. So I wanted to kind of take some time and tell you about the experience we had working with the Central Bank of Brazil and setting up Rails, which is the product of my company, a co-founder called Parfum. So Parfum, just for context, is a company started in 2020. We have about 80 plus employees. We have offices in Brazil, UK, and Portugal. We raised more than $35 million in venture capital. And the two co-founders are myself, Alex, and Marcos. I'm kind of a techie guy. Marcos, he's an ex-banker. He used to be the CTO and COO of BTG Pactual, which is the biggest, the largest investment bank in Latin America. And so we have built two products. One is called the Parfum platform, which is a mixture of, let's say, Talos and Fireblocks. This is a very kind of Latin product oriented. And Rails is our new product, which is a blockchain for banks. And this is the thing we're going to be talking about today. And so what is Rails really? Is two things, is what we call the Rails node. This is a fork of Geth for the people that are more technical. But we changed it so that it can reach 10,000 TPS and it has an enterprise-grade database in the backend and regulatory compliant and so on. This is meant to be installed on-prem by the banks. And then the Rails public chain is coming soon. It's Ethereum-based EVM layer 2 blockchain based off the Arbitrum Orbit stack. And this is being launched this year. And so what is that we really try to do with Rails as a product is, so on the one hand, you have TradFi, the banks and so on. On the other hand, you have DeFi. And these two things have been working in silos. And so what we're trying to do is to combine these two things, and hence, these two products that we have. Because the idea is if we can unlock the liquidity of TradFi and the users of TradFi, and if they can use DeFi, and then on the other hand, if the TradFi can access the innovation of DeFi, then that's the future we want to build. And then one thing you can do with the Rails node, one of the things I showed before, if many banks install the Rails node, they can connect to each other, and then they form something we call the subnet. Okay, so many banks have installed this. and created the subnet. And this is the case I want to show you what was used in the Central Bank of Brazil. Just quickly, because I realize, Parfin and Rails are more known outside of Latin America, not so known outside of Latin America, just to get an idea of the kinds of clients we work with. It's typically large financial institutions. So we've been working with the Kinexis, JP Morgan team, Central Bank of Chile, the BIS. We just joined Agora, Central Bank of Brazil, and then a bunch of banks. And then we have two financial institutions already in production, Nuclea and Cielo. Those are Brazilian entities. Nuclea is the biggest financial market infrastructure provider in the Southern Hemisphere. It's a massive company. They process more than $4 trillion in payments per year. And so they've been tokenizing commercial receivables for the last several months. They are now tokenizing 10,000 receivables per week. And so this is a list of the use cases we tackle, but again, I wanted to just talk about this one, Central Bank of Brazil. And so the story is this: when we got approached by the Central Bank of Brazil, they had this setup. There was a Hyperledger Besu, and the idea was every bank would access Hyperledger Besu directly via RPC, or some of them would even be a validator. But then, of course, you have two problems. One is privacy, because if bank A can see all the transactions of bank B because they are validators, then it just it doesn't work, right? They're competitors. And also scalability, because Hyperledger Besu has a limit of transactions per second. And so, if you add more banks and more users, especially if you put all your clients on chain, then it's going to clog up the whole thing. So what is the solution we came up with? And this is what is already there installed in the Central Bank of Brazil, is to have every bank install the Rails node. So they have their own on-prem blockchain system that they can use internally. They can put all their clients in that blockchain. And that blockchain in a hub and spoke model is connected to every other blockchain. We call it a ledger, right? Actually, the Rails node has like a ledger inside. So the Rails node is connected to one another, every other bank, through the Hyperledger Besu in the middle. So Hyperledger Besu then becomes kind of like a messaging layer. And that is what we have set up. And then we built this, what we call the Rails protocol, to make sure that communication between the different Rails nodes from bank to bank is fully encrypted. And so this has been used in the pilot one, as the central bank calls it. But then more recently, and this is the thing we're doing now in 2025, is we're adding this new technology called Enigma in the Hyperledger Besu. So what happens here now is that the token exists now inside of Hyperledger Besu, the CBDC, and then this is what gets transferred. Enigma is based on zero knowledge technology, and so the advantage of this is that the transactions, they become fully atomic. And this is just like a representation of what actually happens, right? So if you imagine that the orange on the top is the Central Bank of Brazil, they mint DREX, which is this wholesale CBDC, and then they can then send this to any other bank in the system, and they can mint as many as they want, and they can send multiple DREX to different participants in the same transaction. One of the advantages of the system is, you can batch transactions. So if you have 1,000 clients of bank 1 or bank 2 trying to transfer, funds to 1,000 clients of bank 3, this becomes a single transaction in the Hyperledger Besu, and so you add a lot of scalability. Yeah, and so just as a point of next steps for the Central Bank of Brazil, so we've been participating with them since 2023. 2024 is what they finished the first pilot one, as they call it. They have assessed a few different technologies to provide privacy and scalability. Rails is the only one that managed to deliver all the workflows they're looking for. And now we are in pilot 2, which is finishing the selection for the privacy solution. The idea is for this to go into production in the coming months, years, as there's not a clear timeline yet. Yeah, and with that, thank you so much. I want to make sure that I don't stand behind between you, everyone, and home.
Thank you so much.
Thank you.
Any question?
Okay.
Okay. Thank you so much. Yeah. So this will be our closing presentation for today, and thank you all for attending our innovation room presentations, and see you next time. Ciao.